Good morning, students. And today we are going to start a new topic, a very important and a very relevant topic, which is Ind AS 16 property, plant, and equipment. So, students, before starting this standard, and of course, this is an asset based standard. So, for May 23 or November 23, whatever standards we have read so far in this October or November season, I would say that we have started with the basic standard, which is relating to the presentation of financial statement, which is Ind AS 1, Ind AS 7, Ind AS 8, right? Ind AS 10. Then we started with the revenue related standard, which is Ind AS 115, revenue from contract with the customer. And now we are starting with Ind AS 16, property, plant, and equipment, which is a very important asset based standard. If you understand this standard carefully, if you read this standard and understand this standard diligently, I would say that 50% of intangible asset standard, which is Ind AS 38, will be completed. I would say that 50% of Ind AS 40 investment property standard would be completed. So if you complete one standard, which is Ind AS 16, so probably when you will read Ind AS 40, you will feel some revision. When you read Ind AS 38, you will feel some revision. Okay. So it is very important to understand Ind AS 16, property, plant, and equipment. Let's understand what all standards are available for property, plant, and equipment in India. In India, we are already well versed about accounting standard, right? We are already well versed about accounting standard. In India, earlier we were having AS 10 and AS 6. AS 10 was talking about property, plant, and equipment. Earlier, the name was fixed assets. Okay. But now, from 1st April 2016, the name AS10, the name of AS10, which was accounting for fixed asset, has been changed to property, plant, and equipment. Right. And the AS6, which was earlier standard that got deleted effective 1st April 2016. So in accounting standard, there is only one standard which talks about fixed assets, is property, plant, and equipment standard, and that is accounting standard 10. So students who have read accounting standard 10, the revised accounting standard 10, property, plant, and equipment, I would say that in revised AS 10 and in Ind AS 16, there is no major change. In the earlier standard versus Ind AS 16, there was major change, but now there is no major change. So in AS, we were having accounting standard 10. In Ind AS, we are having Ind AS 16. Ind AS 16. So Ind AS 16 again, in Ind AS, we have Ind AS 16, and Ind AS 16 talks about again property, plant, and equipment. Globally in IFRS, we have IAS 16. In IFRS, we have IAS 16. Okay. So when you will read your GFRS paper, when you will prepare for your GFRS paper, IAS 16 is applicable. When you read Ind AS for financial reporting paper, Ind AS 16 is applicable, right? And in accounting standard, AS 10 is applicable. So for you guys, for financial reporting paper, Ind AS 16 is relevant. There is no difference between Ind AS 16 and IAS 16, right? Yeah. So let's move on. And friends, before starting, let me know what is meant by property, plant, and equipment. What is meant by property, plant, and equipment? What is meant by property, plant, and equipment? I can see the good morning of a lot of students. Good morning, Hari. Good morning, Manini. Good morning, Dhara. Good morning, Rohan. Good morning, Radhika. Yeah. What is meant by property, plant, and equipment? And can you give me some examples of property, plant, and equipment? Because you all are CA final students. You are into your articleship. You have completed CA Inter. You have read AS10. So you have fair idea about this standard. What are the examples of property, plant, and equipment? The examples of property, plant, and equipment could be plant and machinery, furniture and fixtures, equipments, land, building, aircraft, right? Electrical installations, okay, vehicles, trucks, ships, or what could be the examples of property, plant and equipment. So these are the examples of property, plant and equipment. And before starting this standard, let me show you the balance sheet of Reliance Industries Limited. Please let me know if the balance sheet of Reliance Industries Limited is visible. So friends, this is the annual report of Reliance Industries Limited for 21-22. So first of all, let me show you the balance sheet of Reliance Industries Limited. When you look at the balance sheet of Reliance Industries Limited, this is the standalone balance sheet of Reliance Industries Limited. And let me show you what is the number of property, plant and equipment. If you see the number of property, plant and equipment, it is 2,23,824. 2,23,824 crores. So closely 2.25 lakh crores relating to the property, plant and equipment. 2.25 lakhs crores. Okay. And what is the total asset size? The total asset size of Reliance Industries is 8.78 lakhs crores, close to 9 lakh crores. So out of the 9 lakh crores balance sheet, 2.25 lakh crore balance sheet is relating to your property, plant and equipment. It means closely 30% belongs to your property, plant and equipment. 30%. It is one of the major line item in the balance sheet of Reliance Industries Limited. 2.23 lakh crores relates to the property, plant and equipment. And let's move on to the schedule number 1, which is your PP schedule number 1. Okay. Let's go to the schedule number 1. Yeah. So let's see in this 2.25 lakh crores, what is my PPE? What is my PP? And this is the PP schedule. I hope you can see this PP schedule. When you look at the PP schedule, there is a land. What are the class of PP? Land, building, plant and machinery, electrical installation, equipments, furniture and fixtures, vehicles, ships, aircraft and helicopters, right? So this standard talks about property, plant and equipment. When I talk about land and building, these are the properties. When I talk about plant and machinery, electrical installations, right? When I talk about plant and machinery, this is plant, property, plant, and these all other items are kind of an equipment, right? So friends, the standards property, plant and equipment. Property, plant and equipment. So property, plant and equipment are those items which are used for the business purposes, We will discuss this later on. But these are the class of asset which is given by the Reliance Industries Limited annual report, right? Land, building, plant and machinery, electrical installation, equipments, furniture, fixture, vehicles, ships, aircraft and helicopters, right? So I want to show you the practical side of it, right? So that we can set the context. Let's move on to the PPT now. And friends, let's discuss what is the agenda of this standard, right? What is the agenda of Ind AS 16? So as far as Ind AS 16 is concerned, of course, first of all, we will talk about the objective of the standard, which is a theoretical part. Objective of the standard, we will talk about objective. Then we will talk about the scope part, right? What is the objective of the standard? On which items the standard is applicable? Then we will discuss the recognition part. We'll discuss the recognition part. So when an item has to be recognized as per PPE, when an item has to be recognized as property, plant and equipment under Ind AS 16 in the books of accounts. And in that, we will be talking about initial cost and subsequent cost. Initial cost means if I have purchased a truck, right? So of course, my initial cost is the cost of truck, right? So at the time of initial cost, what are the recognition criteria? Which criteria needs to be satisfied for recognizing an item as a property, plant and equipment? Then we will be talking about subsequent cost, like if I have purchased a truck and after 3 years or after 4 years, I have incurred a major expenditure on that truck, right? So what will be the treatment of subsequent cost on that property, plant and equipment in accordance with Ind AS 16? So whether that subsequent cost needs to be recognized as a property, plant and equipment, or that subsequent cost needs to be debited to P&L, needs to be debited to P&L. So we need to discuss this. We need to look at that aspect. Okay. Then friends, we will be talking about measurement at recognition. So when I am recognizing an item today, then what is the measurement criteria? So first we have talked about the recognition criteria. Recognition means whether that item will be considered as a PP or not as a PP under Ind AS 16. Once you have decided, yes, it is a PP, then at the time of recognition, what will be the measurement criteria, right? So what are the element of cost? What are the measurement of cost, right? What are the element of cost? For example, when you go to buy a car and when you ask for a price, he will give you X showroom price, right? Then he will give you on road price. So what is meant by X showroom price? What is meant by on road price? So in the X showroom price, the road tax is not included, which is for the lifetime, right? And let me tell you, I bought a car in the last month and it costed me, X showroom price was close to 15 lakhs rupees, right? And the road tax was close to 1.25 lakh rupees. So that road tax is also going to be capitalized in the cost of the car, right? So you will debit your car and you will credit your cash and you will capitalize the car with the value of price of the car plus road tax plus initial charges, which you have given to authority as well, right? Measurement after recognition. So at the time of recognition, initial recognition means at the transaction date. For example, if I purchased a car today, then at what value this car is going to be recognized, at what value? This is known as a measurement at recognition. Measurement after recognition means at the reporting date. For example, in the November, I have purchased a car. What will be the treatment of this car on 31st March, right? On the reporting date. So standard says that the car has to be dealt in on the reporting date, either at a cost model or at a revaluation model, means how the carrying value is calculated for this car. So if you will apply the cost model, it has to be at cost less accumulated depreciation. You have to reduce the depreciation, less accumulated impairment losses. And if there is any impairment as per Ind AS 36, which is impairment of asset standard, if there is any impairment, that impairment has to be deducted while calculating the carrying value of the car. In case of a revaluation model, this is not a new thing. You all have read this revaluation model in your earlier accounting standard 10 as well. When you have opted for revaluation model, in that case, the car has to be revalued. I mean to say the property, plant and equipment has to be revalued on a sufficient intervals at the reporting date. This means that property, plant and equipment has to be fair valued, right? And then we will be talking about what will be the treatment of revaluation loss, what will be the treatment of revaluation surplus, right? So we will be talking about all this aspect at the time of measurement after recognition discussion. Then in this standard, depreciation aspects are also covered, right? So depreciation, what is meant by depreciation? What are the methods of depreciation, right? So we will be talking about this depreciation in Ind AS 16 as well. And depreciation, of course, comes into picture when you have initially recognized the property, plant and equipment, then on the reporting date, you will charge the depreciation. Then we will discuss what is meant by depreciable amount, what is meant by depreciation period, depreciation method. And of course, we will touch upon impairment as well, although impairment is not the authority of this standard. Impairment is the authority of Ind AS 36. Then we will discuss if an entity is getting any compensation for impairment, then what will be the accounting treatment. And the last one is derecognition. So once we have discussed the recognition, so once we have recognized, once we have measured and recorded in the books of accounts, now if the asset is approaching the end of the life, if asset is approaching the end, then how it is going to be derecognized, right? And the last one is disclosure. What are the relevant disclosure for Ind AS 16, right? So friends, we will be talking about the entire life cycle of the standard. First, whether it will be call out as a PP, which is recognition condition. If yes, then at what value it is going to be recorded in the books of accounts, right? Then what will be the criteria for recognizing subsequent cost? How subsequently it is going to be measured, right? Your carrying value, depreciation, impairment, then the end of the life. If the asset is going to be derecognized, then what will be the accounting treatment and what are the conditions, right? And how this entire asset life cycle is going to be disclosed as per Ind AS 16. I hope the agenda is clear to everyone, guys. I hope the agenda is clear to everyone. Yeah? Good. So it's a virtual session. The more you interact, the more you respond, I would be able to know that whether you are able to understand or not, right? Good, guys. Coming to the objective part, of course, this standard talks about the accounting treatment of property, plant, and equipment. It also talks about how to recognize the asset, recognition criteria of the asset, determination of the carrying amount in the balance sheet on the reporting date, depreciation charges, and impairment losses. This standard talks about these 5-6 aspects relating to the property, plant, and equipment. Now, on which item Ind AS 16 is applicable? Ind AS 16 is applicable to all kind of PP, except means negative list is given. What is the negative list? It is applicable to all kind of PP except PPE classified as held for sale. So friends, when you read Ind AS 105, which is subsequently in the month of November only, when you read Ind AS 105, you will find that Ind AS 105 covers those non-current asset. The title of the standard is non-current asset held for sale. And please tell me whether property, plant, and equipment is non-current or current. Property, plant, and equipment is non-current. Why? The intent is not to sell the property, plant, and equipment, right? The intent is not to sell the property, plant, and equipment. The intent is to use the property, plant, and equipment in the business, right? Property, plant, and equipment is not an inventory. It is not held for sale. But if there is a building, if there is a land, if there is a machinery, there is a vehicle which have been classified as held for sale, entity wants to sell that, not in the ordinary course of business, but of course entity needs money, or entity is not forcing any use of that asset and entity wants to sell that asset. In that case, that asset will not be treated as per Ind AS 16. That asset will be treated as per Ind AS 105, and that is why if PPE classified as held for sale, it is outside the purview of Ind AS 16 and it will be covered under Ind AS 105. Maruti Suzuki India Limited, car. So Maruti is manufacturing and selling car. So friends, cars are PPE or cars are inventory for Maruti? Cars are PPE or cars are inventory for Maruti? What is your view? DLF is selling flats. DLF is selling properties. Whether these properties are PPE or these properties are inventory for DLF. What is your view, guys? You're right, Rohan. Cars are inventory for Maruti and inventories are always held for sale. And if car is inventory, it is not a PPE, right? It is an inventory and it will be covered under Ind AS 2. Good. Properties, yes. These are also inventory for DLF. Inventory for DLF. Why? Because the ordinary course of business is to sell the properties. The ordinary course of business of Maruti Suzuki India Limited is to sell the cars. Okay. So if PPE is classified as held for sale, then there is a separate standard which takes care of those PPEs which are classified as held for sale. If the intent of the entity or the objective of the entity is to sell those kind of PPEs in the ordinary course of business, then these items will not be classified as PPEs. these items will be classified as non-current asset held for sale. Okay. Ind AS 41, agriculture asset. Okay. Biological assets related to agricultural activity. Ind AS 16 is applicable to all kind of PP except biological asset. What is meant by biological asset? Biological asset means living animal or plant. Living animal or plant. This is the definition of biological asset. So Ind AS 16 is applicable to all kind of PPA except the biological asset which is related to agricultural activity, right? Which is related to agricultural activity. And biological asset means living animal or plant. If I talk about living animals, right? For example, the entity has purchased cows for plowing the fields, for plowing the agriculture field, okay? And the cows are purchased for milking purposes. So these are the agricultural activity, right? If these cows are purchased for plowing the field, for agricultural purposes, for milking purposes, so in that case, those cows will be covered under Ind AS 41. But friends, have you seen any circus? Have you seen any circus where the tiger is, jumping towards rings of fire, the goat is riding bicycle, the monkey is sitting into that rickshaw? Have you seen any circus in your life, or probably on the television? Have you seen the circus? Rohan is saying yes. Manin is saying yes. So the animals which are used in the circus, is it for agricultural purposes or is it for commercial purposes? What was the objective of those animals? Is it for agricultural purposes, or those animals have been acquired by that event management company for the purpose of entertaining the audience so that they will be able to sell their tickets, they will be able to sell their show? What is the objective? The objective is, of course, commercial purposes. The objective is non-agriculture. It is commercial purposes, right? So whether we can say that the animals, the biological asset purchased by this event management company will be covered under Ind AS 16? Yes, yes. Why? Because only those biological assets will be excluded which is related to agricultural activity, and these animals are not related to agricultural activity, and hence these biological assets will be covered under Ind AS 16. Otherwise, if it is related to agricultural activity, then the right standard is Ind AS 41. Ind AS 41 title is agriculture. Okay, clear? Third example, you must have seen the event management company or this marriage, the companies which are arranging the marriages. Okay, the companies which are arranging the entire events of marriages. They have a horse, they have a mare, right? This horse and these mares are used to take the grooms, right? The grooms are using that horse or mare, right, for the barat purposes. So when these grooms are using this horse or mare, or this event management company have acquired or purchased this horse or mare, of course it is a biological asset, but whether horse and mare is used for agricultural purposes, answer is no. These animals are required to be used for the event management purposes, for the events, for the wedding events, right? So in this case, these biological assets are not related to agricultural activity, and hence this event management company will show those biological assets as a PPE, property, plant and equipment, right? Sir, what about the plant? So you have talked about animal, what about the plant? So friends, the plants which bears the fruits or agriculture produce for more than 1 year, right? Like bearer plant, these are known as a bearer plant. So there is a concept of bearer plant. What is meant by bearer plant? Bearer plant are those plants which produces the agriculture produce, which produces the fruits for more than 1 year. Can you give me an example of a plant which produces the fruits for more than 1 year? Of course, there are a lot of examples. Radhika is saying mango tree. You're right, Radhika. So mango tree is a bearer plant. Why? So mango tree produces Mango tree produces mangoes for more than 1 year. Coconut tree produces coconut for more than 1 year. Tea tree, coffee tree. So these are 100 years old trees, right? So this tea tree, coffee tree bears agriculture produce. What is tea? What is coffee for more than 1 year? So these plants are known as bearer plant, and bearer plant are covered under Ind AS 16. Okay, but if it is non-bearer plant, then it will be covered under Ind AS 41, right? So friends, biological assets related to agricultural activity is outside the purview of this standard. But if the biological asset is not related to agricultural activity, it will be covered under Ind AS 16. And the another exception is bearer plant. Please write down. Bearer plant will be covered under Ind AS 16, even though that bearer plant is related to agricultural activity, even though, right? Mango tree is a bearer plant, and mango tree is covered under Ind AS 16. Okay. Dhara is asking, sir, what if an animal, let's say cow, has a calf which is not doing agricultural activity? So will calf come under Ind AS 16 and cow under Ind AS 41? Dhara, first of all, we have to see if there is no any use of a calf, right? Because calf is a very small animal and he is not competent to be used for the agricultural purposes, right? In that case, of course, it is kind of an animal which will be covered under Ind AS 41, right? But if the calf has grown as a cow and the mother cow is of course used for agricultural purposes, milking purposes, or let's say agricultural field purposes, then that mother cow is under Ind AS 41. But the calf which has grown bigger, which has become elder, and if that calf which becomes a cow now is used for the commercial purposes, I mean to say used for the transportation purposes, in that case that calf has to be accounted for under Ind AS 16. Okay, but if there is no use of that calf because that calf is very small, in that case it will be your Ind AS 41. It will be covered under Ind AS 41 only, right? I hope, Dhara, you are clear on this. Ind AS 106. Recognition and measurement of exploration and evaluation assets. The companies which are into the mining business, right? And they're extracting iron ores, they're extracting minerals, rights and mineral reserves such as oil, natural gas, and similar non-regenerative resources, right? Coal. So the entity like Coal India Limited is into, these companies are having a lot of mines and they're extracting coals, they're extracting mineral rights, they're extracting mineral reserves, right? So these are covered under Ind AS 106, and hence these kind of assets, these mining assets, I mean to say these ores, this extraction of mineral rights and mineral reserves will be covered under Ind AS 106, not under Ind AS 16, right? Although the standard will be applicable to property, plant and equipment which are used to develop or maintain the above assets. For example, Adani has mines, right? And if Adani is using cranes to extract the ores, extract the mineral ores, right? That crane will be covered under Ind AS 16, right? But that ores, exploration and evaluation assets, these will be covered under Ind AS 106, right? So we talked about what is covered, what is not covered under Ind AS 16. Everything is covered under Ind AS 16 if it is a PPE, except if it is held for sale, it is going to be excluded. If it is a animal which is related to agricultural activity, it is excluded, right? Or if it is a non-bearer plant like tomato, potato, carrot, so these kind of plants will be covered under Ind AS 41. But if it is a bearer plant which is giving agricultural produce for more than 1 year, it will be covered under Ind AS 16 only. Then your exploration and evaluation assets, mineral rights and mineral reserves, these are also excluded from the scope of Ind AS 16. Why? Because there is a separate standard Ind AS 106 which takes care of these items, right? Now let's discuss what is the definition of PPE. What is the definition of PPE? And before that, let me move to my Excel file. And please confirm if my Excel file is visible. Ind AS 16 property, plant and equipment. It is very important to understand the definition of property, plant and equipment. Very important to understand the definition of PPE, right? Friends, objective we have discussed, scope we have discussed, right? For objective, for scope, you have to refer the PPT. Agenda we have discussed for this standard, right? And for agenda, again, you have to refer the PPT, PowerPoint presentation. Okay. Now coming to the most important aspect, definition of PPE. What is the definition of PPE? Definition of PPE. Definition of property, plant and equipment. Property, plant and equipment are the tangible items, Property, plant and equipment are the tangible items which are held for. Tangible items held for use in production or supply of goods and services, or held for rental purposes or administrative purposes, held for use in production or supply of goods and services, right? Held for rental purposes, right? Or held for administrative purposes, And it has to be used for and used for more than one period. So my dear friends, this is the definition of PPE. Tangible items, right? Tangible item which is held for use in production or supply of goods and services or rental purposes or administrative purposes, and which is going to be used for more than one period. If these three conditions will satisfy, this plus this plus this, then it will be known as a PPE, tangible item. What is meant by tangible item? Tangible item is which you can see, which you can touch, like furniture and fixtures, land, property, building, aircraft, machinery, factory, right? Your refrigerator, your television, laptop, computer, right? So these are the tangible items. So tangible item which is held for use in production or supply of goods and services. For example, machinery is used in production, aircraft is used for services, right? Blue Dart, when you read the balance, when you will see the balance sheet of Blue Dart is a courier company. So they have some aircraft in their balance sheet. Why they are using that aircraft? They are using the aircraft for the logistic purposes, right? The aircraft have been used for transporting the goods from one place to another place because these are the courier company, right? Delivery has a lot of trucks, for example. So these trucks are used for the transportation of services, transportation of goods, right? So tangible item which is held for use in production or supply of goods and services. Maruti, cars for Maruti. So cars for Maruti is not a PPE. It is an inventory, right? These cars are not used in production or supply of goods and services. But the machinery which is manufacturing the cars in Maruti factory, those machinery are, of course, defined as a PPE, property, plant and equipment. Those assembly lines are defined as PPE, okay? Or held for rental purposes, right? You must have seen some construction sites, okay, whenever you go to the construction site, there are a lot of equipments like cranes, that mixture machine, right? So there are many companies which are giving these machines to the real estate companies or construction companies on a rental basis, right? So in this case, these companies which are giving their machineries on rental basis, right? So these machineries are property, plant and equipment for these kind of companies, right? You must have seen that the event management company are giving luxury cars on a rental basis. So these luxury cars are PPE for these event management companies, right? JCB is giving cranes on rental basis. These cranes are PPE for JCB. Or administrative purposes, there are fire extinguisher, which is for safety purposes. There are table and chair, furniture and fixture. The employee is using the chairs, the employee is sitting on the chairs, and they are providing a services for more than 8 hours, 9 hours, 10 hours. So these are known as for administrative purposes, right? And to be used for more than one period, right? Is it clear to all of you? And to be used for more than one period. More than one period means generally for more than 1 year, right? More than one accounting year. I hope that definition of PPE is clear to all of you. I have shown you the different class of PPE in the Reliance Industries annual report as well. But friends, there is an exception. And what is the exception? Please write down these exceptions. Land and building held for rental purposes is covered under Ind AS 40 standard, which is the standard on investment property. Not under Ind AS 16. For example, a company acquires a lot of properties. So they have acquired a lot of buildings in Lakshmi Nagar in Delhi. Okay. And why they have acquired a lot of buildings? Because they want to give those buildings on a rental basis to the students, to the CA students. Because they know the CA students would come to Lakshmi Nagar for the CA preparation, for the preparation for CA examinations. So land and building held for rental purposes is covered under Ind AS 40, because Ind AS 40 says that any land and building which is held for rental purposes will be the investment property. So Ind AS 40 provisions will be applicable, not under Ind AS 16, right? Sir, then you have written this rental purposes, then what is the use for this rental purposes? Friends, I have taken an example of JCB. JCB is giving a cranes on a rental basis. So these machineries, these cranes will be covered under Ind AS 16, not under Ind AS 40. Under Ind AS 40, only two assets, land and buildings are getting covered, not other assets are getting covered, right? Only land and building. Okay. So other than land and building, if any item which is held for rental purposes by an entity, so for that entity, it will be classified as property, plant and equipment. It will be classified as property, plant and equipment. So Manini, yes, it is 12 months. Generally, it is 12 months. Okay. Manini is asking computer and laptops. Of course, computer and laptops are also a tangible item. But what about software? Manini, what about software? Is it a tangible item? Answer is no. So software is not a PP. It is an intangible asset, right? Brand name, goodwill. Of course, the first definition, the first part is it should be tangible item. Second, it should be held for use in production or supply of goods and services. It should be held for rental purposes or administrative purposes. And it should be used for more than one period, which is technically 1 year. Okay. So let me go back to my PPT once again. So what is PP? PP is a tangible item which is held for use in production or supply of goods and services, or held for rental purposes or administrative purposes and expected to be used during more than one period. That is known as a PPE. Now let's quickly discuss this case study 1 to understand the PPE much better. XYZ Limited has acquired a land to construct a plant for manufacturing of goods. XYZ Limited has acquired a land to construct a plant for manufacturing of goods. It also acquired below item for the business, machine A for the production, building for rental purposes, truck for transportation of goods, furniture and fixture for office administration, laptop for the employees, SAP software for maintaining records. Identify whether above item are PPE or not. Friends, please tell me. Machine A for production, sorry. Yeah, first of all, land. Tell me whether this land is PPE or not. First of all, you need to see the intent of that land. XYZ Limited has acquired a land to construct a plant for manufacturing of goods. This means this land has been acquired not for rental purposes, for the business purposes. So yes, this land will be PPE. Machine A for production. Is it a tangible item? Answer is yes. It is held for use in production of goods. And of course, it will be used for more than one period. Yes, it is a PPE. Building for rental purposes. Is it a tangible item? Answer is yes. Is it held for goods and services? Answer is no. Held for rental purposes? Answer is yes. But it is a investment property. Why? Land and building held for rental purposes is an exception from the Ind AS 16 standard. Why? Because it is specifically covered under Ind AS 40 standard. Okay. So this is not a PPE. This is Ind AS 40 investment property. Truck, is it a tangible item? Answer is yes. It is held for supply of goods and services. And of course, it is expected to be used for more than one period. Yes, truck is a PPE. Furniture and fixture, it is held for administrative purposes. It is a PPE. Laptop, of course, it is a tangible item. It is a PPE. It is held for the administrative purposes. SAP software, is it a tangible item? Answer is no. It is an intangible item. It is not a PPE, right? So friends, land is a PPE, plant is a PPE, machine is a PPE, building is an investment property, truck is a PPE, furniture and fixture is PPE, laptop is PPE, SAP software is not a PPE. Yeah. Yes, Girish. Building is Ind AS 40 investment property. Manini is asking, sir, manpower is also used for production and tangible. Then it is under Ind AS 16 PP, under Ind AS 16. So Manini, first of all, please tell me whether manpower will be recognized as a PP, whether manpower will be measured in the balance sheet. Tell me, can you say that a company has purchased a manpower? Whether as a substance, can a manpower will be purchased? So manpower is not a tangible as well as it is not an intangible, right? It is not an intangible, right? So you need to see the substance. Manpower is not a PP, not an intangible asset. So no any balance sheet will recognize the manpower, right? Of course, the cost of services provided by manpower. Yes, Manini, even though if it is hired, then what you will do? The cost of manpower, the cost which you are paying, the rental cost, not rental cost, the hiring cost, right? The salary or the consulting cost which you are paying for manpower, either it will be charged to the P&L or it will be capitalized as a cost of the relevant asset, right? For example, you are constructing a factory and you have hired laborers and you are paying wages to the laborers right? In that case, those wages or you are paying salary to the employees who are engaged in the construction activity of the factory. So where those costs will be capitalized, not as a manpower cost. Of course, the manpower cost will be capitalized in the cost of the factory. Okay, so that will be shown under Ind AS 16 PPE, under the class of assets under PPE, it will be shown as a factory. It will be shown as a plant and machinery, right? Are you getting, Manini? Is it clear? I hope it is clear to you. Yeah. Let's move on, friends. Now let's discuss, sir, we have understood what is PPE. For any item to be classified as a PPE, it should be tangible, first of all. It should be held for use in production or supply of goods and services. It should be held for rental purposes, or it should be held for more than 1 year. More than 1 year. Okay. So, but when it has to be recognized as a PP, standard says that an item has to be recognized as PP when two conditions will be satisfied. When two conditions will be satisfied. So let's discuss the recognition criteria. Recognition criteria. What is the criteria for recognizing an item as a PP? Recognition criteria. What is the recognition criteria? Recognition criteria. What is the recognition criteria? Standard says that an item has to be recognized as PP when two conditions will be satisfied. When two conditions will be satisfied. What are those two conditions, friends? Can anyone tell me if he or she will be aware? What are the two conditions? An item will be recognized as PPE if below two conditions will be satisfied. What are the two conditions? Condition number 1. Future economic benefit. Economic benefit will be probable. Future economic benefit will be probable. So future economic benefit is probable, not will be. I would say that future economic benefit is probable. And the second one is cost can be measured reliably. If these two conditions will be satisfied, then that item will be recognized as PPE. Sir, what is meant by these two conditions? And friends, these two conditions, I would say these two conditions would be applicable to every asset. Although additional criteria could be there, but these two basic criteria would be there for every kind of asset. Right? For recognizing an item, there should be future economic benefit which is probable. For example, I have bought a car, right? So friends, I have bought a car. Now please tell me whether future economic benefit from that car is probable or not. Whether I can enjoy the rights, I can enjoy the benefits of that car or not. Can I drive the car? Answer is yes. Can I use the car? Answer is yes. Can I take myself or my family on a long drive from that car? Answer is yes. Can I use that car for let's say going to any places, taking the goods from one place to another, right? So of course I will enjoy, I will consume all the benefits associated with the car, right? So of course future economic benefit is probable, and of course cost is also known because I have purchased the car. Generally, point number 2 will be satisfied always. Why? Because if you purchase something, you know the cost, right? Okay. So this car has to be recognized as PPE provided that definition of PPE will be satisfied, right? Why I'm saying the definition PPE will be satisfied? Because the same condition is applies to software also. But it is not qualifying the definition of PPE because it starts with tangible and software is intangible. Now let's take another example. I have purchased a car which is a diesel car. I have purchased a car which is a diesel car. And the moment I purchase the car, the government has banned the diesel car. The government has banned the diesel car. Friends, can I say that future economic benefit is probable? Can I say that future economic benefit is probable? Tell me, friends. Can I say that future economic benefit is probable? Radhika is saying no, sir. Okay. What about others? Future economic benefit is not probable. You are right. Why? Because I will not be able to consume the benefits associated with that car. I cannot take that car on the road. Probably there would be a challan from using that car. I would not be able to use that car freely. I would not be able to sell that car properly. I mean to say that car will be sold out as a scrap sale, right? Otherwise, this car would not be sold under and I will not be able to fetch a proper value of the car, right? Future economic benefit is not probable. Future economic benefit is not probable. In that case, it will not be recognized as a PP. Sir, then what to do? In that case, it will be charged off to the P&L probably, right? It will be charged off as an expense. Okay. Second example, I have purchased a machinery from China. And the time when the machinery reaches to the Indian factory, the government has banned the output which has been produced or which is going to be produced from that machinery. So government has not banned the machinery. Government has banned the output from the output which is going to be produced from that machinery. So then what is the use of that machinery? The machine is used for producing that output only. And the output which is going to be produced from that machinery, government has banned the output. Now, friends, tell me whether future economic benefit seems to be probable from that machinery. Answer is no. Whether that machinery will be capitalized as a PP, will be recognized as a PP, answer is no. Right? So an item will be recognized as PP if below two conditions will be satisfied. First one is future economic benefit is probable and cost can be measured reliably. Cost can be measured reliably. Right? Cost can be measured reliably. Are you getting me? Friends, this recognition criteria is same for initial cost as well as subsequent cost. You remember in my agenda slide, I have talked about the initial cost and subsequent cost. Like I have done a major expenditure on the truck, right? So recognition condition is same for initial cost as well as subsequent cost. Recognition condition is same for initial cost as well as subsequent cost, right? Is it clear? Is it clear? We will discuss about subsequent cost. Don't worry about that. Okay. So friends, coming to the recognition criteria, there are two recognition criteria. It is probable that future economic benefit will flow to the entity from using that asset. And cost can be measured reliably. Yeah. So this will be recognized as a PPE. Friends, if there are spare parts, for example, if I'm buying a car, I'm also buying in spare parts. Spare parts, standby equipment and servicing equipment. These spare parts, standby equipment and servicing equipment will be recognized as a PPE if the PPE recognition criteria is met. Future economic benefit is probable and cost can be measured reliably. And the second one, it will be qualified as a definition of PPE. I mean to say, if that spare parts has to be used for more than 1 year, the life of the spare part is more than 1 year, it is going to be capitalized as PP. Otherwise, it will be Ind AS 2 inventory standard, right? Clear? For example, I've used a spare part, which is going to be changed after every 3 months. So it will be classified as an inventory, not as a PP, right? Coming to the subsequent cost. What is the subsequent cost? Friends, tell me what could be the subsequent cost, right? So let's talk about the subsequent cost. Subsequent costs. Very important part, guys. Subsequent cost. Subsequent costs are in the form of major replacement, overhaul, and major inspection, right? And major inspection, right? Major replacement, right? Major overhauls and major inspection. The word is major replacement, overhauls and major inspections are capitalized, or I would say that recognized as PPE if recognition criteria is satisfied. Right, is satisfied. So friends, the company has purchased a truck, right? And the life of the truck was 10 years. After 6 years, the engine got damaged and the company was advised to replace the entire engine. Is it a small replacement? Is it a replacement like, whenever you purchase a vehicle, you go to the service, there is a change of air filter, oil filter, diesel filter, engine oil you have to put in the vehicle, right? You understand air filter, that was a very small item. It is costing around 200 or 300 rupees, right? Diesel filter, oil filter. So these are costing around 1000 rupees, 1500 rupees, 500 rupees, right? Engine oil, 1500 rupees, right? Let's say you are replacing your tires. Okay. So friends, is it a major replacement? Answer is no. But the entity has replaced the engine. Is it a major replacement? Answer is yes. Probably if the price of the truck is 30 lakhs or 25 lakhs, the cost of the engine is 5 lakhs or 6 lakh rupees. So this is a major replacement. So the question arises, sir, whether this major replacement, the replacement of engine, is going to be capitalized as a cost of the truck, or this cost of the replacement of engine, this cost of the engine is going to be charged to the P&L. Standard says that the recognition condition is same for initial cost as well as subsequent cost. So what is the subsequent cost? The subsequent cost is the cost of replacement of engine. And what is the recognition criteria? The recognition criteria is future economic benefit is probable and cost can be measured reliably. So we are aware about the cost. So friends, if this engine would not be replaced, then what will happen? Then the entity will not be able to run the truck. And of course, the benefits of truck will not arrive. The benefit of the truck will not be arrived. And hence, by replacing the engine, future economic benefit is probable. And the cost is also measured reliably. So this cost of engine should be capitalized. But day-to-day cost for small repairs. But what about day-to-day cost? Day-to-day cost, small repairs, service cost are charged to P&L. It is not going to be capitalized. You will say that, sir, if I'll not get the service of my car on a regular intervals, probably it will not be able to run. And hence, the service is also tantamount to a future economic benefit. Whenever I'll do the service, then only I will be able to get the future economic benefit from that car. Then why not to capitalize the service cost? So friends, the intent is not to capitalize every small item relating to the car. The intent is to capitalize the major replacement, because if you will do the major replacement, it will even increase the life of that asset also, right? Because that will impact, that will be having a huge impact on that particular asset, right? Or overhauls. Overhauls means again a major expenditure, right? And major inspections. Major inspection means, for example, in case of a aviation industry, for example, Indigo Airlines. So in these kind of industries, the aviation authority says that in every 3 year or in every 5 year, you have to get the inspection of your car. You have to get the inspection of your aircraft, right? To see that whether the aircraft is airworthy or not, because you are dealing with the lives of the people, right? You are dealing with the lives. So even though your aircraft is running very smooth, but still at every fixed interval of time, you have to get it inspected. And let me tell you, friends, the inspection cost is not a small cost. The inspection cost is into the lakhs, okay? Like 15 lakhs, 20 lakhs, 50 lakhs, 1 crore. So these are the kind of inspection cost which this airline industries has to incur at a regular intervals to confirm that, yes, these aircrafts are airworthy. And if these are not going to be inspected, then these entities are not allowed to fly those aircrafts, even though those aircrafts are perfectly fine. Right? Is it clear, friends? Is it clear? Let's understand understand this thing with the help of an example, right? Example. The company has purchased a truck for rupees 20 lakh on 1st April 2015, right? The company has purchased a truck for rupees 20 lakhs on 1st April 2015. On 1st April 2015, right? Life of the truck is 10 years. Life of the truck is 10 years. Life of the truck is 10 years, right? On 1st April 2020, the company has replaced engine of the truck for rupees 5 lakh as it becomes faulty and the truck was not able to run. On 1st April 20, the company has replaced the engine of the truck as it becomes faulty. And of course the truck was not able to run. Not able to run. And what is the price of this engine? Replace the engine of the truck for rupees 5 lakh. Right? On 1st April 2015, on 1st April 2015, friends, on 1st April 2015, tell me whether the engine was part of the truck when the truck was purchased. Of course, yes. Of course, yes. So truck was purchased including engine. Of course, yes. Truck was purchased including engine, right? Truck was purchased including engine on 1st April 2015. And what about on 1st April 20? On 1st April 20, what happens on 1st April 20? On 1st April 20, one engine has been purchased for replacement. And same needs to be added to the cost of the truck, right? One engine has been purchased. One engine has been purchased on replacement, and same needs to be added to the cost of the truck, right? Because it is a major expenditure, it is a subsequent cost, and of course both the condition will be satisfied, so it has to be capitalized. So now the gross block of the truck. What is my gross block of the truck? 20 lakhs plus 5 lakhs. So the total is, let's say, 25 lakhs. The total is 25 lakhs, right? So gross block of the truck is 20 lakhs plus 5 lakhs, total 25 lakhs. Friends, please tell me, do you find this treatment right? Don't you think when the truck was purchased, there was an engine. When this truck was purchased, for example, this is a truck, right? This is a truck. This is a truck. When this truck was purchased, there was an engine, okay? And on 1st April 20, another engine was purchased. And it was added to the cost of the truck. Don't you think that there is one truck and there are two engines? There is one truck which is having two engines, which is not right. There is one truck which is having two engines, which is not right. Right? So of course, one engine is only providing benefit to this truck. This one engine is only usable, the other engine is not usable. So don't you think if we need to capitalize the new engine, so probably we should de-recognize the old engine, right? Why? Because this truck, this PP is a balance sheet item. This PP is a balance sheet item. So the engine cost has already been added to the truck, and the truck was having an old engine. When you are replacing the old engine, I mean to say you have pulled out the old engine and you will fit the new engine, then of course the cost should be remain for one engine only, right? And what would be the correct treatment? The correct treatment that the cost of the new engine should be capitalized, but the cost of the old engine should be decapitalized, de-recognized. Am I right? But sir, when we have purchased the truck and the dealer has raised the invoice, for example, Mahindra and Mahindra or Ashok Leyland, when these dealers have sold me the truck, at that point of time, the invoice was not having any bifurcation of what is the cost of the engine and what is the cost of the truck other than engine. There was no bifurcation. So how would we able to know what was the cost of that engine? How would we able to know? So this is not the right treatment. This 25 lakh is not right. Sir, then what is right? So right is standard says that if there are major subsequent cost, if there are major inspection, major overhauls, major expenditure, major replacement, in that case, you have to add those expenditure as a cost of the asset if recognition criteria is meeting. But at the same time, you have to de-recognize the old cost. You have to de-recognize the cost of the old engine as well. Now the bigger question is how to de-recognize the old engine from PPE. So you have to de-recognize old engine from PPE. De-recognize old engine from PPE. How to de-recognize old engine from PPE? So first of all, if the value is given, then well and good. If the value is not identifiable, how to arrive at a value to de-recognize the old engine? How to arrive at a value to de-recognize the old engine, right? So standard says that, first of all, if the value is identifiable at the time of purchase, then use that value for de-recognition. If value is identifiable at the time of purchase, so use the depreciated cost, use that value for de-recognition. If the value is identifiable at the time of purchase, use that value for de-recognition, right? Second, what is the second one? If value is not identifiable, then what happens? If value is not identifiable, then standard says that use the current value. But sir, the truck was purchased on 1st April 15 and we are replacing on 1st April 20. So technically after 5 years, right? So probably if I have spent 5 lakh today, so the cost would not have been 5 lakh rupees at that point of time. Even every year there is an inflation also. There is increase in cost also. So standard says that don't worry. If value is not identifiable, then use the current value as a surrogate cost. Surrogate means as a substitution cost or as an alternative cost, and discount it to the present value to arrive at the original value. So if today cost is 5 lakh rupees, and let's say the discount rate, the incremental rate of borrowing for the entity is 10%. So what would have been the cost 5 years back? So discount it to 5 years back. It will give you the present value at that point of time, which is of course less than 5 lakh rupees. So sir, how we will do that? Let me show you. If value is not identifiable, then use the current value and discount it discount it to the date of original purchase to arrive at the original value for derecognition. Right? How to arrive at a value to derecognize the old engine? If value is identifiable at the time of purchase, use that value for derecognition. If value is not identifiable, then use the current value and discount it to the date of original purchase to arrive at the original value for derecognition. Right? Clear? Not clear? Don't worry. Now I will explain with the help of this example which I have taken. So friends, what is the today's cost? What is the current cost? The current cost is 5 lakh rupees for replacement of an engine. Okay? For replacement of engine. What is the discount rate? For example, the discount rate, which is incremental rate of borrowing for the entity, is, let's say, 10%. Then what is the present value factor? What is the present value factor? Present value factor 5 years back equal to 1 divided by 1 plus 10% to the power 5. It gives me 0.621 as a present value factor. Okay. Now, what is the value? What is the estimated value? What is the estimated value 5 years back? What is the estimated value 5 years back? The estimated value 5 years back is equal to 5 lakh multiply by 0.621. It is coming out at 3,10,460 rupees. 3,10,461 rupees. Okay. This is my estimated value 5 years back. 310,461. Clear? Now, how we will do this accounting treatment? So friends, what was the total cost of the truck? Total cost of the truck at the time of purchase. It was 20 lakhs. It was 20 lakhs. 1, 2, 3, 4, 5. The total cost of the truck was 20 lakhs at the time of purchase, right? Now, what is the cost of the engine? What is the cost of engine? Cost of engine. Or let's say, I would say estimated cost of engine. Estimated cost of engine. This is how much? 310,461. Cost of remainder truck. This is 1689,539. Right. So friends, in this case, we are able to identify the cost of engine. Sir, now what would be the accounting entry? Friend, this is the value on 1st April 2015. This is the value on 1st April 2015. Now this truck, the engine was replaced on 1st April 20. And what was the life? What was the life of the truck, friends? The life of the truck was 10 years, right? The life of the truck was 10 years. It is given in the question. It means the depreciation has to be made for 10 years, right? So let me find out what is the closing balance. What is the net carrying value at the time of replacement of engine, right? So let me calculate the value as on 31st March 2020 because the engine is going to be replaced on 1st April 2020, right? So what is the life, useful life? The useful life is 10 years. So of course, the entire truck must have been depreciated over the life of 10 years, right? Over the life of 10 years, the entire life of the truck is 10 years only. So what is the carrying value? Carrying value as at 31st March 20. Why I am calculating at 31st March 20? Because engine has been replaced on 31st March 20. Sorry, 1st April 20. So I am calculating the carrying value as on 31st March 20. So before calculating the carrying value as on 31st March 20, let's calculate accumulated depreciation till 31st March 20. Right? Accumulated depreciation till 31st March 20. Yeah, what is my accumulated depreciation? This divided by 10 multiply by 5. Same formula will apply here. So 50% would have been depreciated. But sir, when we were charging depreciation, we were not aware about the cost of the engine. Yes, you are right. So we were charging the entire amount of the truck over a period of 10 years, which should give me the 10 lakh rupees, right? And you can see that we have depreciated 10 lakh rupees so far. What is the breakup? This is the breakup which we have calculated today. Are you getting me? If you will look at your fixed asset register, you will find that in 5 years, we have depreciated 10 lakh rupees out of this 20 lakh rupees. Now we are only giving a breakup of that, right? So what is the carrying value of this truck as on 31st March 20? 3,10,461 is the estimated cost of original engine. 155 to 230, 50% have been depreciated. So the closing value is 155,230. The closing value is 844,770. And 10 lakh rupees of the entire truck is remaining as of now, right? So this amount of 155,230 is going to be derecognized. Now, what is the accounting entry? What is the accounting entry? So let me give you the accounting entry. What is the accounting entry? The accounting entry at the time of derecognition. At the time of purchase, first of all, let's say at the time of purchase. 1st April 15, right? 1st April 15. What was the accounting entry? PPE truck account debit. How much amount? By 20 lakh rupees, right? To cash account or to bank account. To bank account, 20 lakh rupees, right? Every year there would be a depreciation every year. So from 31st March 15, sorry, 31st March 16, there would be a depreciation. What will the accounting entry? Depreciation account debit to PP or to ECDEP, right? To ECDEP. And this ECDEP will be reduced from PP to ECDEP, or I would say to PP, right? How much amount? 10 lakh rupees. 10 lakh rupees. 31st March 16 to 31st March 20. This is the accounting entry. Now, on 31st March 20, or let's say 1st April 20. 1st April 20. What is the accounting entry on 1st April 20? I need to split this truck PP. I need to split this truck PP. This PP truck debit, PP engine debit to PP truck credit, right? So when I say PP truck, I am talking about PP truck other than engine, right? So I have bifurcated this amount on 1st April 20 because I need to derecognize this also, right? So how I bifurcated, for example, this 10 lakh, first of all, the 10 lakh rupees of this PPE, which is remaining, I have 20 lakh minus 10 lakh. This is the value which is remaining. So I bifurcated this value into truck and engine. What is the cost of the remaining carrying value of the engine? The remaining carrying value of the engine is 155,230. The remaining carrying value of the truck is 844,770. So this is the value. Now, at the time of replacement, So these accounting entries at the time of replacement. Again on 1st April 20. PPE engine. PPE new engine. Of course, visually the part of the truck only. Don't worry. Okay. PPE new engine debit by how much? By how much? Guys, by 5 lakh rupees. PP new engine debit by 5 lakh rupees. To cash. To cash. How much? By cash or bank, whatever, 5 lakh rupees. Next entry, derecognition of old engine. Again on 1st April 20. Loss on derecognition. Account debit in the P&L to PP old engine. To PPE old engine. What is the value? The value is 155,230. The value is 155,230. I hope it is clear to all of you, sir. If we will get some scrap sale, for example, the old engine sold at 50,000 as a scrap, then what will the accounting entry? Then what will the accounting entry? Cash account debit. Cash account debit 50,000. PP old engine will be of course created by 155,230. This will be created by 155,230. And the difference will go to loss on derecognition account debit, which will be a difference between 155,230 minus 50,000, right? 1,05,230. I hope the concept is clear with the help of this example. So friends, when you are incurring a major replacement, major expenditure, major overhauls, major inspection, at that point of time, you have to derecognize the old component from the gross block, old component from the carrying value, so that in one asset, two component will not be capitalized, because the future economic benefit has been given by the one component only. Let me look at if you have any query. Manini is asking similar value at market. So friends, if you can compute the value, I have told you that if the value is identifiable, of course you have to take that value. If the value is not identifiable, then you have to use the current cost, discount it to the present value at that point of time, and split the asset and compute the depreciation, compute the carrying value, and derecognize the carrying value. Of course, you will not derecognize the entire 3 lakh. You have to derecognize the net depreciated cost, because you have used that old engine which is inside the truck at least for 5 years, right? So Rahul, is it clear to you? Rohan, Radhika, is it clear to you? Manini, Dhara, Hari, Aniket, Soham, Sumit, is it clear to all of you? Yes. Friends, I'm not getting any response. I hope I'm audible to everyone. I'm not getting any response since last 5 minutes. It would be great if you can respond. Okay, great. Soham is asking, sir, if in this question it was to repair the engine, so will that be charged to P&L even if the truck was not able to run before repair? Soham, in that case, you have to see whether it was a major repair, I mean to say major overhauls. For example, the company has set a materiality. What is meant by major? Because standard has not given anything like that, right? For example, the company has set the materiality, any expenditure beyond 5% or beyond 10%. Any expenditure beyond 5% or beyond 10%, right, will be considered as a major expenditure, right? So Soham, if there was a major repair, right, so in that case, that major repair is going to be capitalized, right? And if it is a small repair, for example, you have spent around 1 lakh rupees, 1.5 lakh rupees, or 2 lakh rupees on the repair of the truck, probably it will be charged to the P&L. It will be charged to the P&L. Okay. Yes, now I have got a lot of responses. Yeah. So I hope you guys have understood this concept very well, right? So let me read this subsequent cost slide. So for subsequent cost, same criteria needs to be followed as initial recognition, added in the carrying amount of PP if the recognition criteria is met. And what is the recognition criteria? Probable that future economic benefit will flow and the cost can be measured reliably. Day-to-day servicing cost, which includes labor and consumable, needs to be expensed off. It can be in the form of replacement cost, major inspection, major overhauls, etc. Right? So this illustration number 8 I have already covered as my illustration. MS Limited has acquired a heavy machinery at a cost of rupees 1 crore with no breakdown of component parts. In my example, I have taken an example of 20 lakh with truck. The estimated useful life is 10 years, same example. At the end of 6th year, in my example, it was at the end of 5th year. One of the major component, the turbine was the major component of this machinery. The major component which was turbine require replacement. As further maintenance is uneconomical. So this turbine requires a replacement. The remainder of the machine is perfect and is expected to last for the next 4 years. The cost of a new turbine is 45 lakhs. The discount rate assumed is 5%. Can the cost of new turbine be recognized as an asset? If so, what treatment should be used? So friends, the old turbine cost is not given. The new turbine cost is given. The old turbine cost is not given and the new turbine cost is given. So what we need to do in this case, please tell me. In this case, what is required to be done? So friends, let me show you the Excel file of this, right? So this is already there in my Excel file. Let me show you this illustration number 8 of study material. And when you look at this study material illustration, you will find that the new turbine will be added to the cost of the machine and the existing turbine will be derecognized, right? So new turbine, like new engine has been added and the old engine has been derecognized. Likewise, the new turbine will be added to the cost of the machine and the existing turbine will be derecognized, right? And now what is the cost of the existing turbine? What is the cost of the existing turbine? The cost of existing turbine, we are not aware the cost of existing turbine, but we are aware about the cost of new turbine, which is 45 lakhs. Discount rate is 5%, and this cost is incurred after 6 years. Now, what is the present value of factor 6 years ago? 1 divided by 1 plus 5% to the power 6. It will give a discount factor of 0.746. If you will multiply 45 lakh, multiply by present value factor, it will give us 33,57,969. I have rounded off it to 33,58,000 just for simplicity of the calculation. You can also do that, right? So now friends, what was the original cost of the turbine? So now I have bifurcated the machine between the turbine and machine other than turbine. The total original cost of the machinery was 1 crore. And the turbine estimated cost comes out at 33,58,000, right? So what is the remainder cost of the machinery? It is 66,42,000. Now if the life is 10 years, and we are incurring a cost after 6 years. So of course, for this 1 crore rupees of machinery, 1 crore divided by 10 multiplied by 60 lakh has been depreciated, right? Accumulated depreciation is 60 lakh. So now we are bifurcating between the turbine and machine other than turbine. The accumulated depreciation between the turbine and the machine other than turbine, right? What is my accumulated depreciation in this area? My accumulated depreciation is 20,14,800. So how I have calculated? This divide by 10, multiply by 6. This divide by 10, multiply by 6, and of course the total should be 60 lakhs. Now the net book value is 1343,200 and 2656,800, right? So now this net book value is going to be derecognized. So what is my accounting entry? My accounting entry is new turbine account debit 45 lakh. New turbine account debit 45 lakh. And of course, I need to credit bank account by 45 lakh. Right? Clear? Then I need to derecognize the old turbine. Old turbine 33 lakh 58,000. But there is accumulated depreciation also, or you can directly do the to net PP, to net cost of old turbine, which is 1343,200. But here I have debited accumulated depreciation and credited the gross block of old turbine. So both the numbers I have picked. So what is my net loss? My net loss on derecognition is 1343,200. 1343,200. Now what is the revised cost at the end of 6 years? The revised cost is the new turbine 45 lakh, machine other than turbine 66 lakh 42,000. The gross block become 1 crore 14 lakh 42,000. Now the accumulated depreciation for machine other than turbine is there only, right? Which is 39,85,200. My net book value will become 71,56,800. And of course, both of this will be depreciated over the period of next 4 years if the life has not been increased, right? Clear? So this will be depreciated over the period of next 4 years. I hope it is clear to all of you guys. I hope it is clear to all of you. Let me know if you have any challenge in understanding this question. Let me know if you have any challenge. Yes, Soham, in my, so basically whatever you have asked in that example, derecognition is not required. So Manini, normally companies form the policy of 5% or 10% of the original cost. You are right, Girish. It has to be discounted by, the new turbine has to be discounted by 5% for the last 6 years to arrive at a cost of the old turbine at the time of purchase. Guys, I hope everything is clear with the help of accounting entries and everything, right? So this narrative has been given in the institute study material, but I have shown you with the help of bifurcation of example in the table format and accounting entries so that you will be able to clear on these aspects, right? Friends, let's have a break for 10 minutes. It's 8:33 now. Let's start the session at 8:43, right? the concept of subsequent cost in the form of major replacement. Let me see if there is any query. Yeah. Now let's talk about major inspection or overhauls, right? So sometimes regular major inspection for faults may be a condition of continuing to operate an item. The cost of each major inspection is recognized in the carrying amount as a replacement if the recognition criteria is satisfied. Any remaining carrying amount relating to the previous inspection is derecognized, irrespective of whether previous inspection was separately identified and depreciated. So let me make you understood this concept with the help of an example. Like in case of a aviation industry, in case of an airline company, right? So there is a condition for there is a condition which is given by aviation authority that your aircraft should be inspected at regular intervals, right? And the authority will do the inspection. The authority will charge some cost for that. Okay. Doesn't matter whether your aircraft is airworthy or not, your aircraft is running smooth or not, but yes, you have to incur this cost at regular intervals, right? What does it mean? It means when a company has purchased a new aircraft, always it will be an inspected one. Okay, always it will be a inspected aircraft. It is airworthy. It is good for flying. So, for example, the cost of the aircraft is 20 crores rupees. And the new aircraft is already including an inspected component, an inspection component, which is good to fly for the next 3 years, right? Friends, in 20 crores, 1 crore pertains to inspection cost. Since we have capitalized the aircraft at 20 crores rupees, and after 3 years, we have to again get this aircraft inspected at a cost of, let's say, 1 crore, 90 lakh, 1.5 crore. We are not aware, right? And again, after 3 years, this again inspection will go on, right? So there will be a major inspection cost, which is going to be incurred at the interval of every 3 years or every 5 years. Okay. And the life of the aircraft, the life other than inspection, the life of the aircraft is 20 years. So in the cycle of 20 years, this aircraft is going to be inspected, let's say 4 times or 5 times in the entire life cycle. Friends, standard says that if there is a major inspection, in that case, new inspection cost has to be capitalized. New inspection cost has to be recognized, and old inspection cost has to be derecognized. Old, I mean to say the original, or let's say old inspection cost has to be derecognized, right? If we are aware about the old inspection cost, that is okay. You can derecognize the net carrying value of the old inspection cost. If you're not aware about the old inspection cost, then you need to estimate, you need to identify the old inspection cost by the help of the new inspection cost. You can take the new inspection cost, you can take the discount rate, you can discount the new inspection cost to the present value to the date of original inspection, right? So this is how we are accounting for as a major inspection expenditure, as a subsequent cost. Udan Limited buys an aircraft for rupees 90 lakhs. Under civil aviation rules, the aircraft requires a major inspection every 3 years at a cost of rupees 5 lakh. Right? The cost was 90 lakhs, and the aircraft requires a major inspection every 3 years at a cost of 5 lakh rupees. 3 years after purchases, it undergoes its first major inspection. The cost in relation to this inspection amount to rupees 7 lakhs. Explain how the same should be accounted for in accordance with the requirement of Ind AS 16. So friends, when this aircraft was purchased, that time the inspection cost was costing rupees 5 lakh, and it was already in built-in aircraft cost, right? Because it was a new aircraft. So this was built in 90 lakhs, right? And that point of time, the cost was 5 lakh. But after 3 years, when the actual inspection happens, the cost becomes 7 lakh rupees. The cost becomes 7 lakh rupees, right? So this 5 lakh becomes 7 lakh now. This 5 lakh becomes 7 lakh, right? So friends, in this case, the original inspection cost is given at that point of time. So we are not required to determine the original inspection cost by discounting it to the present value, right? Because it is given in the question. If it would not have been given in the question, then we would discount this 7 lakh by applying the discount rate for the 3 years, right? In this case, the original carrying value would have been allocated as follows. Aircraft plus cost of inspection. Aircraft plus cost of inspection. So 85 lakh is the cost of aircraft. 5 lakh is the inspection cost. 90 lakh is your total cost, right? Ind AS 16 provide that in such case, original cost of inspection is derecognized and the new inspection cost will be recognized in the carrying amount. So new inspection cost will be accounted for as an asset addition and the original cost as an asset disposal. So in this case, how this gross block will look like? Aircraft 85 lakh, inspection component. So there was an original cost of inspection of 5 lakh that should be derecognized, minus 5 lakh plus 7 lakh. So the net is 7 lakhs. So what is my revised gross block? My revised gross block is 85 plus. My revised gross block is how much? 85 plus. It is 85 plus 7 lakhs. It is 85 lakh plus 7 lakhs. Okay. Just a minute. There is a problem in my pen. This is 85. This is 85 plus 7, which is 92 lakhs, Okay. So 92 lakhs is the revised gross block for this aircraft, right? So we have derecognized, we have disposed of the original cost of inspection and we have added the new cost of inspection, right? Clear? I hope it is clear to all of you, friends. I hope it is clear, right? So 85 plus 7. 85 plus 7 will be your revised cost of aircraft. Any doubt? Any question so far? Any doubt? Dhara is asking, why would company add inspection cost before incurring it? So Dhara, the company will not add inspection cost before incurring it. Here the company has already incurred, right? When the company buys a new aircraft, it was already inspected. And the company has already, it was already inspected at 90 lakhs. See, we have done the breakup of 90, 85 plus 5. Why? Because we are aware that the aircraft is going to be replaced after 20 years. But the inspection component is going to be replaced for after every 3 years, right? So we have not capitalized before incurring. We have capitalized at the time of incurring the cost, right? I hope it is clear to everyone, Dhara. I hope it is clear to you also. We have discussed the recognition condition at the time of initial cost as well as at the time of subsequent cost. Now discuss the measurement criteria. Measurement at initial recognition. Measurement at initial recognition. Okay. Soham is asking, sir, but inspection is a service and utilized at that time only, then why to recognize it? Soham, tell me one thing. Tell me one thing. If you have purchased a machinery, right? Because you are a CA final student and you have also read accounting standard 10. So just tell me one thing. If you have purchased a machinery from China, okay? So you have to pay some cost to that machinery. You have to pay the price of that machinery to the Chinese vendor. You have to pay the custom duty also, which is a non-refundable tax. You have to pay the transportation and freight charges also. You have to pay the transportation and freight charges. You will pay or you will not pay? You will pay. You will pay the carriage inward also for that machinery to be transported from China port to the India port, then India port to the factory, right? And there will be installation cost of that machinery also. There will be installation cost. So Soham, will you capitalize all these costs or not? will you capitalize all this cost or not? You have to capitalize all this cost, right? Now you are aware that I am buying a aircraft, I am buying an asset where at a regular interval, I will incur some major inspection cost. At a regular interval, let's say 3 year, 5 year, okay, or 10 years, I would say. So in this case, of course, it is a service which is going to be capitalized. Even at the first time, when I bought an aircraft, I have capitalized, it was already inbuilt. I would say 90 lakhs or I would say 85 plus 5 lakhs, right? So what I will do, 85 lakh, because today I am aware that I have to incur this cost again after 3 years. What cost I am going to incur, I am not aware. But I am aware that the life of the inspection part is only 3 years. Then what I will do, I will depreciate 85 lakhs over a period of 20 years and I will depreciate 5 lakh over a period of 3 years, so that when the second inspection will come, the value of this inspection component will become zero. The carrying amount of this inspection component will become zero. Okay, so the net carrying value will become zero. Clear? So gross block minus ECDEP will become zero. Is it clear? Is it clear? So the intent is, since the first inspection service we are going to utilize for next 3 years, right? For next 3 years, the aircraft will fly. So at the time of the second inspection, this 5 lakh will become zero. It has already been depreciated, right? So I will de-recognize the gross block. I will de-recognize the accumulated debt. Net it will become zero. Why? Because it is in service. When the second inspection will happen, and it will happen at 7 lakh rupees, again, I will depreciate this 7 lakh over a period of 3 years. I will depreciate this 7 lakh over a period of 3 years, right? Over a period of 3 years. Clear? So again, when the third inspection will happen, this 7 lakh will be completely depreciated over a period of 3 years. 85 lakh will continue to be depreciated over a period of 20 years. But the inspection component is going to be depreciated over a period of the inspection, over the period of the life of the inspection, so that the net carrying value itself becomes zero. The accumulated depreciation itself become equal to the cost of the inspection. I hope you have understood, Soham, what is the intent of the standard as far as major inspection is concerned. Clear? De-recognition means you have to de-recognize the old gross block and you have to recognize the new gross block. That's all. Yeah? Friends, is it clear to all of you? Great. Thanks, Rahul. Thanks for such a nice feedback. Thank you so much. Yeah. Let's talk about the measurement. We have decided, yes, this item has to be recognized as a property, plant, and equipment, right? So now the question arises, what will be the value for measuring it, for recording the accounting entry in the books of accounts? Why? Because we understood, yes, it has to be recognized, but at what value? So standard says that the property, plant, and equipment has to be measured at cost. Initially, it has to be measured at cost. Sir, but what is the meaning of the cost? The cost means purchase price. Of course, the price which you are paying, including import duties and non-refundable purchase taxes after deducting trade discount and rebates. I have purchased a machinery from the foreign suppliers and I have paid 10 lakh rupees, right? And I have also paid an import duty of 1 lakh rupees. And I have also paid a GST of rupees 50,000. 10 lakh rupees is the purchase price, 1 lakh rupees is the import duty, 50 rupees is the GST. But Government of India is giving me a credit for the GST, but not for the import duties, right? So friends, whether if I'll get the credit of the GST, it means whatever I have paid, I'll get the refund. So whether the GST, whether the refundable purchase taxes will form part of the cost of the asset, answer is no. But if it is non-refundable purchase taxes, So I have paid 50,000 rupees on this foreign on this asset acquired from the foreign country. The government will not give me any credit. It means this 50,000 will become a cost of asset for me, right? So 10 lakh plus 1 lakh import duty plus 50,000 of non-creditable or non-refundable taxes minus that foreign supplier have given me 20% discount. So minus 2 lakh rupees. If there is any trade discount or rebate, it has to be deducted, right? Plus directly attributable cost. What is meant by directly attributable cost? Had this asset not been purchased, this cost would not have been incurred. Directly attributable cost means the cost which is directly related to the acquisition of the asset. If I would not have acquired the asset, I would not have incurred such cost. For example, the company has purchased a machinery from China, right? Of course, the company has to pay a purchase price, the company has to pay import duty, the company has to pay some taxes also. You have to see it. If it is refundable, it is not form part of the cost. If it is non-refundable, it will form part of the cost, right? After deducting trade discount and rebates, of course, plus directly attributable cost. For example, if the company has purchased a machinery from China, so in that case, the vendor will deliver the machine to the Indian factory. So first, the machine will start from Shanghai airport and will reach to Kandla port, right? So it will carry some transportation cost. From Kandla port to New Delhi factory, the factory is in New Delhi. Again, it will carry some transportation cost or some freight or some carries inward. The machine will require some site planning, site preparation, excavation, civil work, installation, right? And this machine is such a specific or customized kind of machinery that will require a training or professional consultancy as well to use that machinery. That will require training or professional consultancy to use that machinery also. In that case, it will be like a directly attributable cost. Why? If I would not have purchased that machinery from China, I would not have incurred the cost from Shanghai port to Kandla port to New Delhi factory, the excavation cost, the civil cost, the site planning cost, the site preparation cost, the installation cost, the professional training cost, consulting cost. I would not have been incurred such costs. So it means these are the directly related costs, the directly attributable cost. If the directly attributable cost is there, you have to capitalize that part. You have to capitalize those costs as a part of the cost of the asset. Okay. So directly attributable cost is also required to be added as a part of the cost of the asset. Plus initial estimate of the cost of dismantling and removing the item and restoring. Initial estimate of the cost of the dismantling and removing the item and restoring, right? Initial estimate of the cost of dismantling and removing the item and restoring, right? And restoring. What is that? Can anyone tell me what is this? Initial estimate of removing the asset and restoring the site. What is that? Friends, what is that? Can you tell me, please? Let's take an example. I have taken a plot of land on a lease basis, right? For 30 years. And I have constructed my factory on a lease. Right? So when I have constructed my factory on a leasehold land, so the landlord told me that Mr. Alok Garg, you are constructing your factory today. And we have given, for example, government has given this land on a lease basis. So government told this entity that whenever you will move from this place, I mean to say after 30 years, when our contract will be over, you have to restore this plot of land in the same condition in which I have given it to you. What does it mean? It means I have to incur a dismantling cost or a site restoration cost after 20 years, or sorry, after 30 years. I would not have incurred that cost after 30 years if I would not have been constructed the factory today. Right? If I would not have been constructed the factory today. So friends, it means, what does it mean? It means I need to estimate the future dismantling cost, because I'm not aware that if I have to demolish the factory, if I have to dismantle the equipments, dismantling the machineries, of course it will carry a cost. And of course, if I need to restore the site in the same condition in which the landlord has given it to me, of course it will carry some cost. So in that case, friends, in that case, the site restoration obligation or asset retirement obligation or asset dismantling obligation is required to be created. The provision for ARO, the provision for such restoration or such dismantling obligation needs to be created. And such provision has to be added as a part of the cost of the asset, For example, let me take an example with the help of this Excel file. Example of asset retirement obligation. Although you will read this concept in detail in Ind AS 37. Example of asset retirement obligation. Right. So first of all, friends, we have discussed the important concept of measurement at initial recognition, and we have discussed there are three parts. At the time of measurement and initial recognition. The first one is initially. So what is the measurement and initial recognition? It is at cost. And now what is the part of that? So the first one is your purchase price plus what? Import duties plus non-refundable or non-creditable taxes, plus minus trade discounts and rebates. Purchase price plus import duties plus non-refundable taxes minus trade discount and rebates, right? Plus, so this is one. This is the first part. What is the second part? Directly attributable cost. Right? Plus estimated cost of dismantling and restoration. Estimated cost of dismantling and restoration, right? So friends, these are the three component of cost. Okay. These are the three component of cost. This one plus directly attributable cost plus estimated cost of dismantling and restoration. This is the total definition of the cost, right? And what is the example of asset retirement obligation? If you will see the Reliance Industries balance sheet, they will have a asset retirement obligation, right? Let me show you the Reliance Industries balance sheet, friends. And let me show you the accounting policy also for Reliance Industries. Property, plant and equipment are stated at cost, net of recoverable taxes. If it is recoverable taxes, then you have to reduce it, right? Trade discount and rebates less accumulated depreciation and impairment losses. Such costs include purchase price, borrowing cost as per Ind AS 23, and any cost directly attributable to bringing the asset to its working condition for its intended use, right? Clear? Then they have written subsequent cost. are included in the assets carrying amount or recognized as a separate asset. You remember what this policy is trying to say. Subsequent costs are included in the assets carrying amount. Engine, it is included in the assets carrying amount. Inspection cost, it is included in the aircraft's carrying amount, or as a separate asset. If you want to show the engine as a separate asset, you can show it. Okay, as appropriate only when it is probable. What is the recognition condition? When it is probable that future economic benefit associated with the item will flow to the entity and cost can be measured reliably. And the cost can be measured reliably. Sir, whatever you taught us as a theoretical part of Ind AS 16, it is written in the annual report of Reliance Industries Limited, one of the biggest company of Asia. It is written in their accounting policy. Yes, my dear friends. So whatever you are reading in Ind AS 16, whatever you are reading in CA financial reporting, practically this will be asked when you are appearing for interview, when you are practically applying this concept in your real life, right? So these concepts are very helpful. These are not a theoretical concept. These are the practical concepts, right? Clear? Is it clear, friends? So let me show you the asset retirement obligation also, right? Where the asset retirement obligation is there. So friends, let me show you that part. Just give me a minute. Let's go to the balance sheet. And in the balance sheet, I want to show you that asset retirement obligation. Why? Because Reliance has a oil wells in the Krishna Godavari basin. Government has given these oil wells for a period of 30 years. And government has told whenever your contract will be over, you have to restore this place in the same condition in which I have given it to you, right? So they are having a huge amount of asset retirement obligation. Why? Because they have to restore the seabed into the same condition in which the government has given them. Friends, provision for decommissioning of assets. Provision for decommissioning of asset, right? 1598 crores. They have a asset retirement obligation, asset dismantling obligation for 1600 crores in their balance sheet. And let me look at what is the accounting policy for asset retirement obligation. Let's look at the accounting policy also. Okay, that what is the accounting they are doing for this asset retirement obligation. Let me look at that accounting policy. Yes. Friends, the company records a provision for decommissioning cost or asset retirement obligation, decommissioning obligation towards site restoration activity. Decommissioning costs are provided at the present value of future expenditure using a current pre-tax rate expected to be incurred to fulfill decommissioning obligation and are recognized as a part of the cost of the underlying asset. So whenever they have recognized this oil and gas assets, so they have included the estimated cost of asset decommissioning obligation or asset retirement obligation as a part of the cost of the asset. So the credit part is provision, but the debit part they have not expensed off. They have capitalized it as a part of the cost of the asset. Why? Because it is requirement of Ind AS 16. So friends, let me tell you how this has to be calculated. For example, of asset retirement obligation, right? A company has constructed a factory over a leasehold land for leasehold land to be dismantled after 20 years. To be dismantled after 20 years, right? The cost of factory is rupees 10 crores. or let's say 10 lakhs. Okay. And the company estimates the decommissioning or dismantling liability to be rupees 5 lakh after 20 years. The company estimates the decommissioning liability to be rupees 5 lakh after 20 years, right? Clear? In this case, if you will see, so the company has estimated that probably we have to incur, the best estimate would be 5 lakh rupees after 20 years. The discount rate, the current incremental rate of borrowing for the entity is 10%. Okay. So the necessary impact as per Ind AS 16. In this case, friends, what will be my accounting entry? What will be my cost of asset? My cost of asset is equal to cost of construction plus estimated cost of dismantling or retirement obligation. Now the question arises, sir, can we say that it is 10 lakh plus 5 lakh? Answer is no. This 5 lakh is the estimated cost which will be incurred after 20 years. So in this case, you have to arrive at a present value today. What is the present value today if the estimated cost after 20 years is rupees 5 lakh? So cost after 20 years, estimated cost after 20 years is 5 lakh. Discount rate 10%. Period 20 years. Right, period is 20 years. Present value factor, PVF, present value factor. What is my present value factor? 1 divided by 1 plus 10% to the power 20. Right. So it is coming out at 0.149, right? Then what is the present value today? If estimated cost after 20 years is 5 lakh. So the present value today is 5 lakh multiplied by 0.149, which will give you 74,322. Friends, what is the cost of the asset? The cost of the asset is equal to 5 lakh plus 74,322. Right. So the cost of the asset is equal to 5,74,322. What will be the accounting entry, friends? What will be the accounting entry? The accounting entry will be, and you will be able to understand more by help of this accounting entry, factory account debit, factory PPE account debit, 574,322, bank account. Bank account is only 5 lakh. Please understand, the 5 lakh rupees have been incurred only. And 2, provision for dismantling, which is a provision, which is a liability. How much? 74,322. What will happen for this provision for dismantling? So now this asset have been capitalized and this factory has to be depreciated over a period of 20 years, right? So this is at the time of initial recognition. This accounting entry need to be passed and this factory needs to be depreciated over a period of 20 years. Sir, After 20 years, probably the 5 lakh rupees expense has to be incurred. Then how this 74,322 will become 5 lakh? Now there will be a provision accounting. Right? So in the initial period, it is 74,322. In the 0 year, it is 3. It is 74,322, right? What will happen in the next year? 1, 2, 3, 4. What will happen in the next 20 years? In the next 20 years, what will be the opening balance? In the first year, what will be the opening balance? Opening balance, interest cost, closing balance. Right? So in the first year, in the beginning of the first year, the opening balance is this. Interest has to be recognized at 10%, right? So this will become your closing balance. Again, same formula will go on, and at the end of 20 years, this will become 5 lakh. At the end of 20 years, this will become 5 lakh. Okay. This will become 5 lakh. You can see that the discount rate which we have applied for discounting, we have compounded with that discount rate only. It will become 5 lakh rupees. So every year, what accounting entry you need to pass? Every year at the end of the year, the factory cost needs to be depreciated over 20 years. So what is the accounting entry? Depreciation account debit. Depreciation account debit. Account debit to accumulated depreciation or PP, whatever, or PP, right? What is the accounting? What is the number? 574,322 divided by 20. This will give you the number of depreciation every year, right? Depreciation every year. Okay, 28716. And you have to unwind the discount to the provision for dismantling every year. What will be the accounting entry? Interest cost account debit, which will go to the P&L, to provision for dismantling. And by charging interest cost, this will increase to 5 lakh rupees in the next 20 years, right? For example, in the first year, this number will be 7432, right? In the next year, this number will be 8175. So on and so forth, it will go by 45, 445, 455 in the 20th years, right? So friend, I hope you have understood the concept of asset retirement obligation. I have shown you the real life example. I have shown you the calculations. I have shown you the accounting entry. I have shown you the concept. I have shown you everything, right? I hope you have understood this thing. Let me see if you have any queries. Manini is asking, sir, if any penalties given to authorities for any issue, then it will be capitalized. Answer is no. Abnormal costs are not going to be capitalized. Penalties are not going to be capitalized, right? Unwind discount means since you have discounted, so means reversing the discount. Reversing the discount means compounding, charging interest. Okay. Yeah. We have discussed this part. Measurement at initial recognition purchase price, including import duties and non-refundable purchase taxes, after deducting trade discount and rebates, plus direct attributable cost, plus initial estimate of the cost of dismantling and removing the item and restoring, right? What is meant by directly attributable cost? Cost directly related to bringing the asset to the location and condition necessary for it to be capable of operating in the manner intended by the management. So the intent of the management is to use the machinery in the Delhi factory. So whatever expenses we have incurred for taking this machinery from China to India, all those costs are required to be capitalized. These are the directly attributable costs. Okay. For example, employee benefit cost. arising directly from construction or acquisition of PPE. For construction of factory, I have hired some employees, and those employees are directly engaged in the construction of factory. So the salary cost of those employees should be added to the cost of the factory. Cost of site preparation. For machinery, what I have done for machinery, first of all, I have excavated some space. I have, done some civil work, brick work, right? Installation. So these are the directly attributable costs. Initial delivery and handling cost, installation and assembly cost, professional fees, cost of testing. For example, you must have seen in case of metro, when this DMRC has come up with a metro project in New Delhi, so there was a trial run, right? So at the time of trial run, whatever is the costing which is incurred for the trial run, that has to be added. That has to be added to the cost of the asset. But for example, if DMRC will say that for the next 7 days, we will have a trial run. And at the time of trial run, any passenger who wants to travel, so we will charge 50% of the ticket charges, right? So at the time of trial run, if there is a machinery and you are doing a trial run and there are some output which is getting produced and you are getting some money out of that output, so the trial run expenses has to be capitalized. But if there is some income from trial run, that has to be deducted from the cost of the asset. So cost of testing, whether the asset is working properly or not, after deducting the proceeds from sale of any product produced during the testing period. Okay. So this is the example of directly attributable cost. What is not considered as a directly attributable cost? Cost of conducting business in a new location or with a new class of customer, including cost of staff training. I am relocating my business from India to, let's say, Japan. And I am giving a training to all my employees for Japanese language. So this staff training is not a cost which has to be capitalized as a PPE. This staff training will not form part of the directly attributable cost, right? So standard has given some exceptions. Cost incurred in introducing a new product or services, right? So friends, for introduction of a new product or a new services, I've incurred some cost in the form of advertisement. I have onboarded Mr. Amitabh Bachchan for campaigning of my product. So in this case, this advertisement cost will not form cost of the directly attributable cost. Cost of opening a new facility. For inauguration of my factory, I have invited some celebrity, and that celebrity has charged 1 crore rupees for the inauguration, right? So again, cost of that celebrity will not be included as a directly attributable cost to the cost of the factory. Administrative and other general overhead costs, right? For example, audit fees is going on. So audit fees is mandatory. Audit is mandatory for the entire company. So the general overhead cost or administrative cost should not be included as a directly attributable cost, right? So these are the examples of directly attributable cost, which is not covered as a cost of the asset, right? Like advertisement cost, promotion cost, administrative and other general overhead cost, right? Cost of conducting business in a new location. So these costs will not form part of your cost of asset, right? Decommissioning cost, we have discussed that cost towards dismantling and removing the asset and restoring the original site after use. The corresponding obligation recognized as a provision under Ind AS 37. So I've shown you that provision liability of 1600 crores for Reliance Industries. So that has to be accounted as per Ind AS 37. But the debit part should go to the, so the credit part should be as per Ind AS 37, but the debit part should be as per Ind AS 16. For example, building an additional internal wall with condition that the property will be returned in the same condition in which it has been given, right? So then there will be a dismantling or restoration cost will arise. This cost will typically arise in oil and gas, mining and electricity industries. Okay. Clear, friends? Good. So let's discuss the measurement and initial recognition case study number 4. ABC Limited purchased a furnace machinery for gross price of rupees 200 crores, right? ABC Limited purchased a furnished machinery for a gross price of rupees 200 crores. Friends, the word uses gross price. The seller granted 0.5% rebate on the gross price of the machinery. So there is a discount also. 200 multiplied by 0.5% will comes out to how much? 1 crore. 200 multiplied by 1% will come out to 2 crores. So 0.5% comes out to 1 crore. Okay. The gross price includes excise duty of rupees 20 crores for which input credit can be claimed by the company. Friends, what is the definition of cost? Cost includes purchase price is 200 crores, including import duties plus non-refundable taxes. But this 20 crore is a refundable taxes. Okay. So it means this 20 crore has to be deducted from the cost of the asset, because whatever we are paying, we will get the refund out of it. So gross price is 200 crores, which includes excise duty of 20 crores for which input credit can be availed. So 20 crore is not a cost to me, right? And 1 crore, which is 0.5% of 200 crore, that the supplier will give me a discount. So purchase price plus import duties plus non-refundable taxes minus trade discount and rebates, right? Clear? Okay. So in this case, purchase price is 200 crores, rebate less 1 crore, refundable taxes 20 crores. So the total comes out at 179 crores. Okay. It also incurred 15 crores as a transportation, handling and insurance. So it has also incurred 15 crores as a transportation cost. So this is again a directly attributable cost. 5 crores for installation. And of course, if you have to run the machinery, installation is required. And 3 crores for testing and professional fees, right? And at the time of testing, some product have been produced, out of which the company has earned 0.2 crores from selling goods produced out of testing. So this 15 plus 5 plus 3 minus 0.2 crore will be the cost of the furnace machinery. So transportation, handling and insurance 15 crore, installation charge 5 crore, testing and professional charges 3 crore, and of course 0.2 crore will be deducted from here, and net 2.8 crore will be capitalized as a cost of the asset. The company borrowed 100 crores for financing the new purchase at the rate of 10%, right? So the company has taken a loan to purchase this machinery. The entire process of purchase to make the operation took 15 months. The loan was outstanding during this period. And this is a qualifying asset. Why? Because it is given in the question that entire process of purchase to make the operation. So to make this machinery usable, ready for use, it took around 15 months. It took 15 months. The loan was outstanding during this period. Loan was outstanding during this period. Okay. So friends, it means if it is a qualifying asset, the time period is more than 12 months. So it means interest is going to be capitalized as per Ind AS 16. Sorry, as per Ind AS 23 borrowing cost. So it means, what is my borrowing cost? 100 crores multiplied by 10% is a rate for 1 year, but 15 months cost is there. So multiply by 15 divide by 12. So 12.5 crores is a borrowing cost which is going to be capitalized on this qualifying asset, which is a machinery. The company earned 0.1 crore from the short-term parking of the money borrowed pending payment to supplier and meeting all costs. So company has taken a loan of 100 crores, but this 100 crores has not been spent on the one day. This 100 crore, entire 100 has not spent on one day. So the company has, parked some funds in the fixed deposits on a temporary basis. And the company has earned some interest income also. So that interest income will be deducted from the interest cost, right? So 12.5 is not going to be capitalized. 12.5 minus 0.1, 12.4 is going to be capitalized. So what is the total cost of the machinery which is going to be capitalized, which is going at which it is going to be measured in the books of accounts? 216.20 crores is the cost of the machinery, right? 216.20 crore is the cost of the machinery at which it is going to be capitalized, right? Clear? Is it clear? I hope it is clear to all of you, friends. Let me know if you have any challenge, any doubt. Manini, Dhara, Soham, Hari, Rahul, Radhika, Rohan, Girish, Aniket, Sumit, Rashmi. I hope it is clear to all of you. Are you enjoying the session? Are you enjoying the session? Good. Thank you so much. Now, friends, as a part of the cost of the asset, let's discuss the concept of deferred payment credit. And this concept is there in Ind AS 38 intangible assets as well, right? Deferred payment credit. What is meant by deferred payment credit? What is meant by deferred payment credit? Right. For example, if today I'm going to buy some asset, I went to the shopkeeper and I told shopkeeper that I want this machinery. And I asked, what is the price? Shopkeeper told me the price is 1 lakh rupees. I told shopkeeper that I will not be able to pay right away. I need at least 6 months time. I need at least 1 year time to pay you the money, to pay you the consideration. Shopkeeper told me, in that case, the cost of the machine is not 1 lakh. The cost of the machine is 1,05,000 rupees. So friends, what does it mean? What does it mean? It means when I'm going to purchase this machinery right away, the cost is 1 lakh rupees only. The real price of the machine is 1 lakh. But since I am deferring a payment, and that is why he is charging an extra amount from me, and that extra amount is not the real cost of the machinery. The extra amount is finance cost, So friends, why this concept is there? Please try to understand. There are 3 companies in the market, same company dealing in the same product, right? And a user is comparing the financial statement. Why user wants to compare the financial statement? User wants to invest in one of the companies, so he is comparing. For example, a company which has purchased the goods on a cash basis, right? So the company has recognized the PP on, let's say, 100 crores rupees. And the company which has not recognized, which has not paid, which has not acquired PP on a cash basis, on a deferred payment basis, that company has again purchased a PP of 100 crores, but the company is paying 125 crores, right? So the company, if the company will capitalize 125 crores as a user, what will I understand? I will think about that. Oh, this company A has only purchased 100 crore of assets. Company B has purchased 125 crore of assets. It means the company B is more into expansion, right? So friends, standard says that you need to recognize the cost of the PP as the cash price equivalent, right? As the cash price equivalent. If it is due to deferred payment term, if any interest is getting paid, that additional consideration has to be shown as a finance cost. But friends, if that asset is a qualifying asset, means the asset is not available for use right away when it was purchased. It will take some substantial period of time for getting ready for use or sale. In that case, Ind AS 23 says that interest, that borrowing cost is going to be capitalized. So friends, if you are paying an interest to the vendor, and of course it is a qualifying asset, in that case, that interest will be going to be capitalized as per Ind AS 23, not as per Ind AS 16. It is going to be capitalized as per Ind AS 23, right? For example, friends, in case of, let's say, in case of a car, the car is ready for use when the car has been delivered to the customer, right? So car is not a qualifying asset. But if I talk about machinery, if it will take around 1 year or more than 1 year for construction of a machinery, for installation, for getting this ready for use, for preparing the site, right? If all this activity will take around 1 year or more than 1 year, it will qualify as a qualifying asset. And in that case, interest or borrowing cost is going to be capitalized as per Ind AS 23. In nutshell, standard says that the PP has to be recognized or measured at cash price equivalent at the recognition date. In case payment is deferred beyond normal credit terms, difference between the cash price equivalent and the total payment is recognized as interest over the period of a credit, unless such interest is capitalized as per Ind AS 23. right? As per Ind AS 23. Clear? I hope it is clear to all of you. Good. Let's discuss this example quickly, right? Thank you, Soham. Thanks for your feedback. And I'm glad that you are liking this practical approach. Deferred payment credit. On 1st April 2001, an item of property is offered for sale at 10 million rupees. 10 million means 1 crore. With payment terms being 3 equal installments of 33, 33, 333. So the property is offered for sale at 1 crore rupees and payment terms is 33, 33, 333 over a 2-year period. I mean to say on 1st April 33, 33, 333 at the time of purchase, upfront payment is 33, 33, 333. At the end of the first year, it is 33, 33, 333. At the end of second year, it is again 33, 33, 333, right? So these are the 3 payments which has to be paid over a period of 2 years. Implicit interest rate of 5.36% per annum. Implicit interest rate is 5.36% per annum. Okay. You are required to determine how the property will be recorded in accordance with Ind AS 16 and also pass necessary journal entries. Also pass necessary journal entries as okay. So friends, the property is offered for sale at 1 crore rupees and payment term is 3 equal installments, right? Implicit rate of interest discount rate is given at 5.36% per annum. We are required to show how this property will be recorded in the books of accounts. Now, friends, tell me in this case, what is the cash price equivalent for this property? What is the cash price equivalent? How to determine the cash price equivalent for this asset? So, friends, in this case, first of all, let me show you the Excel file so that you will be able to understand this concept, right? Of deferred payment credit. Right. Please let me know if my Excel file is visible to you. Please let me know. If you will look at this illustration number 1 of study material, what is your step 1? Step 1 is calculation of cash price equivalent. Calculation of cash price equivalent. Friends, on the transaction date, there is a payment of 33, 33, 333. And the discount rate is 5.36%. So what is your present value factor at the time of purchase? Of course, it is 1. So today I am purchasing and today I am paying. So the present value is the same number. At the end of first year, we are paying the second installment. What will be the interest rate? Okay, 5.36%. What is the present value factor? Present value factor is equal to 1 divided by 1 plus 5.36%. 1 plus 5.36%, right? So when I multiply 33, 333, multiply by 0.949, I'll get this interest rate. And when I'll divide 0.949 by 1 plus 5.36%, I will get the discount rate at the end of the second year, right? So if I will multiply my payment, which is 3 payments, by present value factor, it will give me the present value, which is 95 lakh, 94, 99, 895, rounding it off to the 95 lakh, right? So what is my cash price equivalent? If I'll pay right away, my cash price equivalent is 95 lakh. So friends, what will the accounting entry I need to pass on 1st April 2001? I need to pass PP account debit 95 lakh to bank account, the first installment 33, 33, 333, to creditors account, the remaining payment 61, 66, 667, right? Now friends, we need to calculate the interest component. How to calculate the interest component? On 1st April 21, the opening balance was 95 lakh, right? We have purchased a property for 95 lakh. The interest was 0. And what was the payment at the beginning? The payment at the beginning was 33, 33, 333. and this payment will be utilized entire for the principal amount. So the closing balance on the date of purchase was 61,66,667, right? And this will become the opening balance for the at the time of second installment. Now we need to compute interest for 1 year on 61,66,667, which is this multiplied by 5.36%. And we need to pay the second installment at the end of the first year, 33,33,333, right? So friends, if I'll pay 33,33,333, so of course I will, as a part of principal, I will pay 30,02,800 because I have to pay interest also. So what will be my closing balance? My closing balance will be the total principal, opening principal 6166 minus principal repayment 30,02,000, right? Now at the time of third installment, this will become my opening balance. Interest has to be calculated on 3163. Payment has to be made for the third installment, and of course your principal plus interest is equal to your EMI, your payment, right? So this will give you the closing balance of 0, right? Is it clear? So what will be the accounting entry on the at the time of second installment? Interest expense will be debited by this amount, right? Creditors will be debited by this amount, and money will be credited, bank will be credited by 33,33,333, right? At the time of third installment, interest will be debited in P&L by 169. Principal prepayment, creditor will be debited by 3163, and bank will be credited by 334. So these are the accounting entry which needs to be passed at the time of deferred payment terms, right? If it would be a qualifying asset, then this finance cost would be capitalized, right? Is it clear, friends? Is it clear? Please let me know if you have understood the concept of deferred payment credit, or I should explain it again. Deferred payment credit is nothing. When you are deferring the payment, of course, there could be a finance obligation, finance cost obligation. In that case, PPE has to be recognized at a cash price equivalent, right? And if the cash price equivalent is different from the total consideration which is required to be paid, the difference will be considered as an interest. Now this interest has to go to the P&L, but if the underlying asset is a qualifying asset, that interest is going to be capitalized till the time asset is ready for intended use or sale, as per Ind AS 23 borrowing cost standard. And even this concept you have read in accounting standard 16 as well, AS 16 as well. Okay, so this is not a new concept. This concept you have read in accounting standard 16 as well. Okay, clear? I hope this accounting entry, this deferred payment credit concept is clear to all of you guys. Let me know if you have any challenge. Still you have any challenge. So Manini, again I'm explaining that if there is a deferred payment credit, the entity is not paying right away. The entity is using the deferred payment terms, right? The entity is deferring the payment. In that case, the PPE has to be recognized at cash price equivalent at the recognition date. At cash price equivalent at the recognition date, okay? But if the payment is deferred beyond normal credit terms, the payment is deferred beyond normal credit terms. In that case, the difference between the cash price equivalent, which is in this case, which was 95 lakh, how we have calculated 95 lakh? If we are paying 3 installment of 333, so we are paying 1 crore rupees. And the discount rate is given in this question 5.36%. And of course, I'm not paying right away. I'm paying after 1 year, I'm paying after 2 years. It means I have to discount it. I have to discount it the same, right? I have to discount the same. So the discounted value will be 95 lakh, right? So the cash price equivalent will be 95 lakh. So where the difference of 5 lakh will go? The difference of 5 lakh will be not considered as a PPE. It will be considered as an interest cost. But if Ind AS 23 permits, in that case, that 5 lakh of finance cost will be shown as a cost of the PPE, right? Otherwise, it would be debited in P&L, right? Manini, I hope you have understood now. Exchange of assets. exchange of assets. Right? What is the concept of exchange of assets? Friends, if property, plant and equipment. So first, friends, we have understood at the time of measurement, we have understood the first concept. We have understood the first concept. And what was the first concept? The first concept was, at first we have understood the measurement, right? Measurement and initial recognition cost. There are three kind of cost, right? We have understood the third part, estimate cost of asset retirement obligation as well. Then we have understood deferred payment credit, right? If the payment terms is deferred, then how to calculate the costs, right? So we have understood the deferred payment credit terms as well, deferred payment credit terms, right? And I have also shown you the illustration for that. After deferred payment terms, there is an exchange of assets, right? So friends, what is meant by exchange of asset? You remember in Ind AS 115, I have discussed from the supplier perspective. DLF is selling two flats. DLF is selling flat to a company which is Mercedes, and Mercedes is giving a car to DLF. Mercedes is not paying money to DLF. Mercedes is giving car to DLF. And we have discussed that point of time. We have discussed how this revenue has to be recognized in the books of DLF. Now we are talking about from the acquirer perspective. The acquirer who is acquiring a PPE. The acquirer who is acquiring a PPE, property, plant and equipment, right? Not on the monetary terms, but rather on the exchange of asset. So a PPE is acquired, in exchange of non-monetary asset or a combination of monetary and non-monetary asset. So exchange of assets. This is more of a barter transaction. This is more of a kind of, we can say that barter transaction. We can also say that it is kind of a barter transaction. Barter transaction. Okay. Friends, if you are buying a machinery, probably you will say your supplier that, see, I will pay you a cash of 20%, and 80% for 80% value I will exchange in the form of an asset, right? So you will give me a machinery and I'll give you a building. Okay. So it could be a combination of monetary as well as non-monetary, or it could be a complete non-monetary. For example, the Mercedes is buying a flat and the Mercedes is giving a car, which is to the supplier. So now we are talking about from the perspective of the acquirer who is buying the asset. For example, what could be the example of non-monetary asset or monetary and non-monetary combination? A building is purchased in exchange of Mercedes car and 20 lakhs of cash, right? A building is purchased in exchange of Mercedes car and 20 lakhs rupees of cash. What is this? This is a combination of monetary and non-monetary asset. Second example, a building is purchased in exchange of an aircraft. This is an example of non-monetary exchange. This is an example of non-monetary exchange, right? This is an example of non-monetary exchange. The question arises, in case of exchange of asset in a non-monetary asset or a combination of monetary and non-monetary asset, how the acquired PPE has to be accounted for. What will be the cost of the acquired PPE? What will be the cost of the acquired PPE? Right. Standard says that in case of exchange of assets, what will be the value of acquired PPE? This is a question which we need to answer. Friends, right? So friends, standard says that if the transaction does not have a commercial substance, asset acquired has to be recorded at the WDV of the asset given. Does not have commercial substance, this word we have also discussed in the revenue standard. For example, I am giving a building to, I am purchasing a building and in return I am giving a building. In a society, I'm exchanging a 3 BHK flat. I'm exchanging a 3 BHK flat number 802 with a 3 BHK flat number 801. Okay. I'm exchanging a similar flat, right? I'm buying a flat, I'm selling a flat. So I can say that the timing and risk and configuration of that asset is similar, is same. So I will say that there is no commercial substance of this transaction. But if I am selling a flat and I'm buying a car, so this transaction is having a commercial substance. So if the transaction does not have commercial substance, I am exchanging a similar asset, identical asset. In that case, whatever asset acquired, for example, I am exchanging 802 flat number 802 with 801. So I will debit flat number 801 PP account debit to flat number 802. But at what value? So whatever is the value of flat number 802 carrying value in my books, that will become the cost of flat number 801. So if the transaction does not have commercial substance, the asset acquired has to be recorded at the WDV of the asset given up. But if the transaction has the commercial substance, then asset has to be recorded at fair value. Guys, are you getting me? When the transaction is happening as an exchange of asset, the exchange could be a combination of monetary and non-monetary. The company is paying cash, the entity is paying cash, little bit, and the entity for the over and above, the entity is exchanging for the other asset. Second, the company is exchanging one asset with the another asset, which is entirely a non-monetary asset exchange, right? So in case of exchange of asset, what will be the value of the acquired PPE? So of course, if the transaction is not having a commercial substance, it will be given in the question as well. In that case, the asset acquired has to be recorded, the PP acquired has to be recorded at the WDV of the PP given up, right? But if the transaction has a commercial substance, right? The transaction has a commercial substance. The transaction, the asset which is involved in the transaction, the acquiring asset and the paying asset, right? This is having a commercial substance. In that case, asset has to be recorded at fair value. And fair value has to be taken up. But sir, what fair value? What fair value? So this fair value has to be taken up as per below hierarchy. Fair value has to be taken as per the below hierarchy. As per the below hierarchy. The fair value has to be taken up as per the below hierarchy. Sir, what is the hierarchy? Number one, fair value of asset given up and the fair value of asset acquired. Fair value of the asset given up and the fair value of asset acquired. Acquired. Which fair value? Fair value of the asset given up oblique fair value of asset acquired. Which fair value? Asset acquired. Which fair value? Whichever fair value is identifiable, whether fair value of the asset given up or the fair value of asset acquired, which fair value has to be taken? So it is whichever fair value is identifiable. Identifiable, right? For example, fair value of asset given up and fair value of asset acquired, both are identifiable. Then fair value of asset given up and fair value asset acquired, both are identifiable. Both are identifiable. Then what will happen? Identifiable. Then what will happen, guys? Then what will happen? Then what will happen? In that case, if both the assets fair value, asset given up as well as asset acquired, both the assets fair value is identifiable, then you need to record at fair value of the asset given up. If the fair value of the asset given up, then you need to record at fair value of the asset given up. Friends, do you remember in Ind AS 115, from the revenue perspective, what I have told, if there is a non-cash consideration, if there is a non-cash consideration payable to by a customer, if there is a exchange of assets, there is a non-cash consideration or there is an exchange of assets, right? What I have told you, I have told you that the supplier will record the revenue on the basis of fair value of the asset acquired, on the basis of fair value of the asset acquired. And you remember, the DLF has recognized the revenue on the basis of the cars, on the basis of the fair value of the car acquired, right? So that I have told you from the perspective of the seller. Now I'm talking from the perspective of buyer, who is recognizing, who is acquiring the asset, who is acquiring the asset. So at what value the buyer will recognize the asset? So of course, buyer will recognize the asset at the fair value of the asset given up. At the fair value of the asset given up. He will say, nah, that I have given you my 20 crore worth of property, right? Because this is what he is paying as a consideration. This is what he is paying as a consideration. And from the revenue perspective, from the seller perspective, seller has to recognize revenue, what he is getting as a consideration. And what he is getting as a consideration, he is getting the fair value of the asset acquired as a consideration. But the buyer, from the buyer perspective, that is a cost. So what is a cost? Cost is the consideration which we are paying. What we are paying? We are paying fair value of the asset given up, right? So if both the fair values are there, fair value of the asset given up and the fair value of the asset acquired, then in that case, you have to record at the fair value of the asset given up. Sir, if both the fair value are not clearly identifiable, if both the fair value are not clearly identifiable, then what to do? Then you don't have any chara, you don't have any choice, right? In that case, you have to record the acquired PPE. You have to record the acquired PPE record at, you have the WDV of what? WDV of the asset given up. I hope these three scenarios are clear to all of you. I hope these three scenarios are clear to all of you. Please let me know if you have any challenge. Please, guys, let me know if you have any challenge. I hope it is clear to all of you, friends. Let me know if you have any challenge. Yeah. So let's discuss this part once again. If PP is acquired in exchange for other non-monetary asset or for a combination of monetary and non-monetary asset, so you are required to measure cost at fair value. Unless the exchange transaction has no commercial substance, in that case, it has to be at the WDV of the asset given up. Right? Or fair value of neither the asset received or nor the asset given up can be measured reliably. Again, in that case, WDV of the asset given up. Right? We have just discussed the third scenario. But if both the assets fair value are clearly identifiable, then you have to give the first priority of the fair value of the asset given up. But if fair value of the asset given up is not clearly identifiable, but the fair value of the asset acquired is clearly identifiable, then you can go with the fair value of the asset acquired. Pluto Limited owns land and building which are carried in its balance sheet at an aggregate carrying amount of 10 million. So Pluto Limited is having a land and building in the balance sheet and the carrying amount is 10 million. Book value is 10 million. The fair value of this land and building is 15 million. The fair value of the asset given up is 10 million. It exchanges the land and building for a private jet. It is acquiring a private jet and the fair value of the asset acquired is also given. Friends, fair value of the asset acquired is given and the fair value of the asset given up is given. So which fair value will give the more priority? You will give the more priority to the consideration which you are paying. You are paying the fair value of the asset given up, right? And of course, this transaction has a commercial substance. Why? The company is exchanging the land and building with the private jet, right? Clear? So Pluto Limited is giving up the land and building, and it is also paying additional cash of 3 million in 3 million rupees. So it is a combination of monetary and non-monetary. So Pluto is giving cash of 3 million. Pluto is also giving a land and building which is having a book value of 10 million, but fair value of 15 million. So friends, what will be the necessary treatment as per Ind AS 16? Tell me, what will be the value at which this private jet is going to be recognized? So this private jet is going to be recognized at 15 million, fair value of the asset given up plus the cash which has actually been paid. So 18 million is the value at which this private jet has to be recognized. Friends, but you have also given up land and building. You need to de-recognize the land and building. So tell me whether you will de-recognize the land and building at 15 million or 10 million. So we have calculated the cost of the asset acquired in case of exchange of assets. So we understood at what amount we need to recognize, we need to measure, we need to record this private jet. But my question is, if you are giving up cash, you will do to credit cash. If you are giving up building, you will credit building, land and building, right? But at what value? At book value or at fair value? Of course, you have to de-recognize at book value. You have to de-recognize at book value. What will the accounting entry? Property, plant and equipment, private jet account debit 18,000. Credit land and building by the book value. Credit cash 3,000, right? And the difference will go as a profit to profit on exchange of assets. To profit on exchange of assets. Soham is asking, sir, what will happen if we are acquiring a PPE in an asset for exchange of goods? Does not matter, Soham. Even in that case, you have to recognize at the fair value of the asset given up. Doesn't matter it is inventory or it is intangible asset or it is whatever, right? So you have to recognize at the fair value of the inventory which you are giving up for acquiring the PPE, right? I hope it is clear to all of you guys. Clear? So thank you so much, friends. Till morning, we have started with the concept of Ind AS 16 property, plant and equipment, and we have discussed what is the definition of PPE. Property, plant and equipment are tangible item which is held for production or supply of goods and services, which is held for rental purposes and which is held for administrative purposes and to be expected to be used for more than 1 year or more than one period. The exception is land and building held for rental purposes has to be covered under Ind AS 40, not under Ind AS 16. Then we have discussed if there are spare parts and servicing equipment, if these are meeting the recognition criteria and definition of PPE, it has to be classified as PPE. Otherwise, it has to be classified as inventory. Then we have discussed if there are living animal or plant, if there are living animals are not used for agricultural activity, then those animals are covered under Ind AS 16, right? If you have purchased a let's say horse for your commercial purposes, cow for a commercial purposes, that cow will be considered as a Ind AS 16 PPE, right? That biological asset will be considered as PPE, right? Or if there are bearer plant, the plant which are producing goods and which are producing agricultural produce for more than 1 year, in that case, it has to be considered as Ind AS 16 PPE, right? So for all the tea and coffee industries, if they have tea farms and coffee farms, those tea trees and coffee trees are Ind AS 16 bearer plants, which is covered under PPE standard. Then we have discussed that that item, that expense has to be recognized as a PPE if future economic benefit is probable and cost can be measured reliably. If these two conditions will be satisfied, then we will recognize that item as a PPE, right? Then we have discussed the same criteria will be applicable for initial cost as well as subsequent cost. For example, major replacement, major overhauls, and major inspection. And we have covered one example of truck and engine, and we have covered one ICAI study material example of machine and turbine, right? So then we have discussed at what value asset is going to be recognized as going to be measured. We discussed that it has to be at cost, and cost means cost includes purchase price plus import duty plus non-refundable taxes minus trade discount and rebates plus directly attributable cost plus estimated cost of dismantling And we have said that in case of estimated cost of dismantling, you have to estimate what is the future cost. You have to discount it to the present value, right? And you have to add this cost as a cost of the asset. The credit will be your provision, and that provision will be compounded year on year so that it will be reached at its value, what you have expected as per Ind AS 37. Then we have discussed, we have did the case study on this cost part. Then we have discussed if the entity is deferring the payment obligation, in that case, at what value the PP has to be recognized. The PP has to be measured at cost, which is cash price equivalent. And the difference between the consideration paid and the cash price equivalent will be considered as a finance cost. And if that asset is a qualifying asset, underlying asset is a qualifying asset, then that finance cost will be capitalized as per Ind AS 23. Otherwise, it will go to the P&L. Then we will discuss in case of exchange of asset, what will happen. In case of exchange of asset, the exchange could be a combination of monetary and non-monetary, or it will be non-monetary. So if the transaction is lacking a commercial substance, identical transaction, right? Identical asset, or the fair value of the asset neither given up nor acquired can be clearly identifiable. In that case, you have to record the acquired PP at the value of at the WDV of the asset given up, right? But if this is not the case, the transaction is having a commercial substance, then PP acquired has to be recognized at fair value. If both the fair values are given, then you have to record at the fair value of the asset given up. Why? Because your cost is the fair value of the asset which you are paying, which you are giving up, right? So this is what we have discussed in detail in the last 3 hours. Thank you so much, students, and I hope you have enjoyed the session, and I hope you have understood the part which I have covered so far. Thank you so much. Thanks, Manini, for your nice feedback. Stay safe, stay happy, and in the next class we will complete Ind AS 16. And of course, I am telling you guys that how it is similar to Ind AS 38 as well, so that when you will read the Ind AS 38, you will find that there is a revision of Ind AS 16 as well as some 30-40% topic of Ind AS 38 you have already covered in Ind AS 16, right? Thank you so much. Bye bye. Take care.